Okay. Good morning, friends. Good morning, friends. Okay, let's now move to advanced capital budgeting decision, which is a new addition in your syllabus. Now, in advanced capital budgeting, I said there are two parts to the advanced capital budgeting. One, which you learn at CA Inter, which is the basics part of it, and second, which you're going to learn additionally here. So, I have broken down the syllabus into 10 subparts are 11 subparts, which starts with basics, investment decision. These two are technically part of CA Inter, basics and investment decision, where I may not discuss even one question, but I'll discuss the concept alone. And I had told you to go through the concept before. I had told you that you go through those concepts before, because whatever you learned at CA Inter is what is going to be tested here. And most of the questions there are what you could have done at CA Inter. I would have picked the questions from there and put it here. Our focus at CA Final is on replacement decision. Even long-term funds versus equity approach is not that critical because you do it in valuation. FCFF versus FCFE is that. APV, inflation, NPV, standard deviation, all these are new additions at final level. In fact, some of this you could have seen even at inter level, because earlier at CA Inter we had a chapter called risk analysis and capital budgeting. They have removed that and now they have migrated that to final. So that is what they've ended up doing. So risk analysis and capital budgeting, which you could have done at CA Inter, may have covered these areas. For some people, risk analysis and capital budgeting would not have been there. And the current CA Inter, they've removed this concept of risk analysis and capital budgeting at CA Inter. So we technically going to focus on replacement decision till option in capital budgeting. That's the area we're going to focus on. Now, in order to do this, let's first quickly go through the basics. We learned that there are 6 techniques of capital budgeting, starting from payback, discounted payback, NPV, profitability index, ARR, which is on average investment, and initial investment, and IRR. These are the 6 techniques we have. In IRR, I have another technique called modified IRR. What is payback? Payback basically refers to the time period in which you are able to recover the initial investment without considering the time value of money. I do not give weightage to the time value of money concept. I just put the cash flow, initial outflow negative 2 lakh. You keep getting 20,000, 30,000, 40,000, 50,000, keep getting inflow. As long as you get back your, sorry, you wait till as you get back your money. Once you get back your entire 2 lakh rupees without giving effect to time value of money, payback is attained. Payback gets attained moment my initial outflow is fully recovered. So payback refers to the number of years taken to recover the initial investment. It ignores the time value of money. There's a formula. Formula is very simple. We calculate something called as a base year. What is base year? Is the last year in which cumulative cash flow is negative. If cumulative cash flow is negative, what is cumulative? Outflow and inflow put together. If it is negative, means payback is not yet achieved. So last year when it's negative, from negative when you move to positive, payback is achieved by the organization. An example was starting with minus 10 lakh. We keep putting these numbers. Here this is the base year. Last time when the cumulative cash flow is negative, then how much negative? 50,000. How much next year? 2 lakh 50. So 2 plus how much negative divided by the cash flow of the next year will give you the payback period. Next come discounted payback. Exactly same thing, just that you will have to do PVF, DCF. You will have to do PVF and DCF. Because of this, you will calculate cumulative discounted cash flow. Formula remains the same. Base year plus unrecovered discounted cash flow of base year. Unrecovered discounted cash flow of base year divided by discounted cash flow of next year. Same example. Here my base year again continues to be year 2. Base year continues to be year 2. The amount of negative is on the higher side, 177. Next year, no discounted cash flow. Only discounted. Don't look at the normal cash flow. Only look at the discounted cash flow. NPV is present value of inflow minus outflow. Nothing much for me to talk about this. Most commonly used method for doing all our problems. Profitability index, otherwise called as benefit cost ratio, otherwise called as present value index, otherwise called as desirability factor, is the ratio of benefit to cost. Benefit cost ratio is the ratio of benefits. What is benefits? Inflow. What is cost? Outflow. So PV of inflow divided by PV of outflow. One good example, NPV of the project is 2 lakh. Outflow is 10 lakh, which means my inflow is 12 lakh, which means my inflow is 12 lakh. NPV is 2 lakh. Outflow is 10 lakh, which means my inflow is 12 lakh. Profitability index is inflow divided by outflow. 12 lakh divided by 10 lakh. 12 lakh divided by 10 lakh. Accounting rate of return. This is the only technique which focuses on accounting data. All other technique focuses on cash flow. Why we focus on cash flow is cash flow cannot be altered by a person by just playing around it. When I say playing around it, for example, profits I want to increase, do WDV method, do SLM method, or you go for provision for bad and doubtful debt write off, don't go for provision for bad and doubtful debt write off. So you can keep doing multiple things in accounting to change your profits. Cash flows cannot change just because of your accounting. We have a direct method of calculating cash flow and an indirect method of calculating cash flow. You would have learned that in cash flow statement. So indirect method may look like that it is based on PAT. No, it is starting with PAT, but working capital changes, everything is factored in that. So cash flow is what is very critical. Cash flow cannot be altered by a person. If you want also, you cannot alter the cash flow of a company, but you can easily alter the profits of a company by changing certain methods. If you just play around the methods, WDV versus SLM, FIFO versus LIFO, weighted average. So that is why profit is not critical. But still one technique talks about profit. A rate is equal to what I get back divided by what I give. So what I get back is profit. What I give is investment. There are two names for investment. One is called initial investment. Second is called average investment. Initial investment is what you invest on day zero. What is average is if you invest 20 lakh rupees on a project, first year you get back something. Second year you get back something. Third year you get back something. Fourth year you get back something. Fifth year you get back something. So you cannot say at any point of time 20 lakh is stuck. So instead of doing every year investment calculation, every year how you can do investment calculation, 20 lakh, for example, in this question, this is my first year investment, 10 lakh. Second year investment is 5 lakh 9950 because I've already got back 4 lakh 9,000. Third year investment is one, not this, okay. Let me see because without time value of money, 10 lakh, 5 lakh 50, negative 50, then investment itself is not there because my investment has come back. So instead of doing all this yearly calculation, they say take your initial investment, take your closing investment and divide by 2. How will you take your closing investment? Closing is equal to scrap value. If scrap value is not given, closing is equal to 0. Closing is equal to 0. So initial plus opening plus closing by 2. Opening is equal to what you invest. Closing is equal to salvage value. Closing is equal to salvage value, which can be 0. Which can be 0. Initial investment 5 lakh. Salvage value 1 lakh. Average is 3 lakh. Average is 3 lakh. Average profit is 1 lakh. ARR on average investment 1 lakh divided by 3 lakh. 1 lakh divided by 3 lakh. Internal rate of return, IRR is the rate of return at which NPV is going to be 0. So in order to calculate IRR, we need one positive NPV and one negative NPV. We may have to start with some random rate, high probability below the question. They'll give you some rates. From there you start your calculation. Get one positive NPV, one negative. If you get a positive NPV, increase the discount rate. If you get negative NPV, reduce the discount rate till you get one positive, one negative. Whenever you do IRR calculation, year, cash flow, PVF, DCF, leave space to do another PVF, DCF, another PVF, DCF, at least 3 times NPV we should be able to calculate. Moment you get one positive and one negative, either we use the interpolation technique or you use the timeline approach. Interpolation or the formula is the lowest rate L1 plus how much NPV you generated at that rate divided by the difference in NPV into the difference in rates, divided by the difference in NPV into the difference in rates. If you are getting a positive NPV, this should ideally get tested in exam. If you get a positive NPV, it means your IRR is more than the cost of capital. Your IRR is more than the cost of capital. And if you're getting 0, IRR is equal to the cost of capital. And if you're getting negative, IRR is less than cost of capital. Now, we need that initial rate to start with. If below the question they give you some rate, start with. Otherwise, you need to do, this is just a guess calculation, may not be always accurate. In exam situation, in the calculator, you will have to do ARR on average investment. What is ARR on average investment? You have to add up all the profits, divide by the number of years, take the average investment, do ARR on average investment, and 2 by 3 is the approximate initial guess rate. Is the so if you do 2 by 3 and you get 12.27, your wish you round off to 12, 13, any number you round off and then start doing your calculation. This is just an approximate number to start our calculation. Approximate number to start our calculation. Assuming the question has already given you below the table, no approx calculation. Just start with what is there below the table and then keep doing it. One place you can use a short method for calculating IRR, which the formula is nothing but future value is equal to present value into 1 plus R the whole power n. Future value is equal to present value into 1 plus R the whole power n. Now in this formula you need one outflow, one inflow. Don't tell multiple outflow, multiple inflow, only one outflow and one inflow, and number of years should be 2, 4, 8, 16, 32. Why this? Because you can keep taking square root and then come downwards. Power 6 means you cannot take a square root, because with square you need to take a cube root. There are certain calculated techniques where even power 6, power 7 can be calculated. I'm not getting into it. But if you have power 2, power 4, power 8, you can try to do it. For example, NPV at a discount rate of 10% is 1250. 11% is minus 200. IRR, timeline approach, 10% 1250. 11% minus 200. The difference here 1450. The difference here 1%. So what we are saying, 1% change in discount rate will lead to 1450 change in NPV. 1450 change in NPV. 1% equal to 1450. Question mark equal to 12. That is, how will 1250 become 0? How will 1250 become 0? 1 equal to 1450. Question mark equal to 1250. What's the question mark? So 12 plus 0.86 is the IRR. 12 plus 10 plus 0.86 is the IRR. The same thing can be done in formula also. The same thing can be done in formula. Next, initial outlay of a project is 50,000. Aggregate inflow, one inflow, 1,04,896. How much is the MIRR? MIRR is modified IRR. I'll discuss. Calculation remains the same. How will we do this? Is future value is equal to present value into 1 plus the R power n. I am getting 1,04,896 equal to 50,000 into cost of capital is of no use to me. Okay, cost of capital is of no use to me. It is used to calculate MIRR, but as of now it's of no use because the future value is given. You divide by 50,000. One square root will make it 1 plus R square. Another square root will make it 1 plus R. Do and tell me. Divide by 50,000. 104,896 divided by 50,000. One square root, another square root is 1.2035. 1.2035 is equal to 1 plus R, is equal to 1 plus R. R is equal to 20.35%. Clear? Next example. Annual cost saving is 40,000. IRR is 15%. Profitability index is 1.064. What is the NPV of the project? This kind of covers a lot of things here. Now, I save 40,000. IRR is the rate of return at which NPV is 0. That does not mean NPV becomes 0. That does not mean NPV becomes 0. So, whenever you apply IRR, PV of inflow and PV of outflow will be same. PV of inflow and PV of outflow is going to be same whenever we apply IRR in the formula. Whenever we apply IRR in the formula. Now the other thing is present value of outflow is today's outflow, whether you do 10%, 12%, 14%, 18%, 20%. Sorry, are others facing an issue? Okay, it should be better now. So my PV of inflow can keep changing as you change the discount rate. PV of inflow, if you change the discount rate, the value will keep changing. PV of outflow does not change based on discount rate because it is today's value. How will it change? Based on discount rate. So here, if I apply IRR here, cash flow, PVF, DCF. What's the IRR rate they've given? 15%. So if I put this year 0, 1 to 4, what is the inflow they have mentioned? Annual cost saving. Tell me 4-year annuity factor. 15% 4-year factor. 1 divided by 1.15 equal 2 point. This is going to be 1. This number is this much. This number is this much. And you get this is PV of outflow. This is not PV of inflow technically. This is not PV of inflow technically. Why this is not PV of inflow? Because this was done at 15%, whereas the cost of capital can be 18, 20, 12, 5, 4. It can be anything. It can be anything. Is this right? Why I am saying this is right? Because my NPV is going to be 0. At IRR, my NPV is going to be 0. So indirectly balancing figure is negative 114, 200. Balancing figure is negative 114, 200. Is this discount rate right? No. It should be 12, 13, 14. I don't know the number. You change the discount rate. Will this number 1 change? No. So 114, 200 is present value of outflow. That is not present value of inflow. Then how do I get present value of inflow? What is the formula for profitability index? PI is equal to PV of inflow divided by PV of outflow. You will get PV of inflow now, and then inflow minus outflow will give you the NPV. Inflow minus outflow will give you the NPV. Again, I am repeating, our present value of outflow can never change based on discount rate. Can never change based on discount rate unless an outflow is happening in the first or second year, which is a rare scenario. In that case, it can change. So here, if you see the calculation, first we used the IRR approach, got the present value of inflow, which is equal to present. Ideally, I should have used the word, this is not PV of inflow, this is equal to PV of outflow. This is equal to PV of outflow. We are using this PV of outflow later. We are using this PV of outflow later to get the PV of inflow and then getting the NPV. I can also tell you one more thing. What is the profitability index? Which means NPV is 0.064 into the cost of project. NPV is 0.064 into the cost of project. Cost is 1, extra is NPV. Extra is NPV. 0.064 into 114, 200 is how much? No, 0.064 into 114, 200. 7,309. Okay. Next, what discount rate do I use for project evaluation? The best approach is to go for cost of capital, but the problem is the cost of capital which is there today can change also. Cost of capital today, we don't use cost of equity. Here also you will learn about two approaches, FCFF approach, FCFE approach. FCFF cost of capital, FCFE cost of equity. So cost of capital is the normal approach, but in a rare scenario, the discount rate can keep changing. 10 becomes 12, 12 becomes 14, 14 becomes 16. In case there is a change in discount rate, extreme caution is needed. PVF of year 2 is not equal to 1 divided by 1.12 2 times. Is not equal to 1 divided by 1.12 2 times. It is equal to, sorry, yeah. It's equal to 1 divided by 1.10 first, then divide by 1.12. You want third year factor, 1 divided by 1.10, then 1.12, then 1.14. You will have to keep dividing by, the newer rate. Any doubts in this? Go through this example. Tell me what should be the discount rate here. Think and let me know. RF plus beta into RM minus RF. What is RF? Okay, beta. I'm least bothered about the company beta. I'm only bothered about the project beta. 1.2. RM. Least bother about what happened in the past 12 months. I'm only bothered about what is going to be in future. Clear? Any doubts on this? So 13 minus 8. Now listen, discount rate for year 1 is 15%. Second year is going to be 16. Third year is going to be 17. Tell me what will be the PVF of year 3? First year 15, second year 16, third year 17. What is the PVF of year 3? 0.6. Okay, let others complete. I don't know the answer. If it increases every year, you cannot do 1 divided by 1.171717. That's not possible. First do 1 divided by 1.15. Then do divided by 1.16. Then do divide by 1.17. 0.641. There are certain rules for calculation of cash flow. Again, may not become very critical for us. Some of this you would have done at CA inter level. Some of this may come in international capital budgeting. In international capital budgeting, they may ask you to calculate the cash flow. So certain rules is, one is depreciation, non-cash item, but still I'll have to consider because of the tax angle. So we'll have to deduct depreciation and add back depreciation. Opportunity cost. If there's any opportunity cost given in the question, you'll have to consider that as an outflow in your cash calculation. Example, rent on own building, salary of proprietor. Some question will say, I can earn a pre-tax rent of 20 lakh. Please deduct before PBT. Some question will say, I can earn a post-tax rental income of 12 lakh. Deduct it after PAT. Deduct it after PAT. If the opportunity cost is opportunity cost before income tax, do before income tax. If it's after income tax, do it after income tax. So, guys, please be on mute. Please be on mute. Opportunity cost is given pre-tax, deduct before PBT. Opportunity cost is post-tax, deduct after PAT. Again, I'm repeating, some of these rules were very, very critical at CA inter level. Final, if they want, they can end up asking it, which is where segment 1 and segment 2 of our material is there, where I think we have a lot of sums. But if you see none of those sums, I would have marked revision because they are not part of my last 10 RTP, last 10 MTP or study material. So I have not made them as a question in my revision. I would not be discussing them, but they are technically something which ICA can test. Sunk cost. What is sunk cost is which has already been incurred by an organization and which does not change based on the decision you're taking. A classic example, I want to put a project in Chennai. For putting a project in Chennai, I'm telling somebody to give me a market survey report. So he goes to every home, does some survey and gives me a report. I have to pay him 1 crore rupee for that. This 1 crore is a sunk cost. This 1 crore is a sunk cost in deciding whether to do the project or not. Reason is, if you do the project, you have to pay 1 crore. If you don't do the project, also you have to pay 1 crore. Assume my agreement is like this, that you give me a first report. Based on that, I will decide to do the project. I'll pay you 1 crore. But if I decide not to do the project, I'll pay you only 40 lakhs. If at all I have an agreement like that. If at all I have an agreement that if you give me the report and it works for me, 1 crore. If it doesn't work for me, 40 lakh. Nobody will enter into, because then there will be a conflict. So he may end up giving a good report. So 1 crore minus 40 lakh is relevant. 1 crore, always it's yes minus no. If you do the project, what happens? If you don't do the project, what happens? The difference is called relevant cost. Relevant cost, no opportunity. 40 lakhs is sunk cost. Overheads, some question will use the word apportioned overheads, general overheads, corporate overheads, distributed overheads. All these are irrelevant. All these are irrelevant. Then what is relevant? Anything which is specific to a project. Anything which is specific. For example, I am taking this batch now. Because of this batch, we are incurring extra electricity cost. That is relevant. But we are also incurring rent because of the batch. We are also incurring rent because of the batch. That is irrelevant, because my team will distribute rent cost even for this batch. But even if I had not taken the batch, I would have paid the rent. I would have paid the rent. So rent is an irrelevant cost, but electricity is a relevant overhead. Electricity is a in the electricity also some part of electricity is irrelevant. Even if I had not taken the batch, some electricity would have been consumed. Some extra whatever I am consuming only is relevant. Working capital we have already discussed when I did there. Changes in working capital, changes in working capital is a relevant expense, increases outflow, decreases inflow. Reward exclusion principle, this is what that FCFF and FCFE says. What is reward exclusion principle is, if you do evaluation for FCFF, what is FCFF is long term providers of money, which is what we normally do. What reward you pay them? Interest to debt guys, preference dividend to equity, preference guys, equity dividend to equity guys. All this is ignored in cash flows. All this is ignored in cash flow. Then where do we consider? In WACC calculation, and you do discounting. So discounting automatically takes care of the reward to be paid to the providers of capital. Discounting automatically takes care of the reward to be paid to the providers of capital. Clear? Any doubts on this? Some question we will use only equity shareholders approach, which is called FCFE approach, In that case, equity dividend is ignored, interest paid considered, repayment of loan considered, like you were doing FCFF and FCFE approach. Incremental principle is our focus should only be on extra item, not on anything which is generally there. For example, just to give an example, I have taken this batch. If I had not taken this batch of classes, 80 students of mine would have cleared, let's assume. Because of this batch, 100 students are going to clear. So the benefit of this batch is extra 20 students clearing, and not saying that entire 100 students have cleared just because of this batch. So what extra is this contributing towards the results? So because of this match, I would be getting extra 40 students. Otherwise, I would have got 200. Now I'm going to get 250 students in the next 1 year. So what extra am I getting is only the benefit out of this and not overall. You cannot say that overall profit is because of this project. An example I said, simple rule for identifying something as relevant or not. A company will incur marketing expense of 40 lakh if they take up a new project. However, the same will not be incurred in case they are not doing the project. As of now, you are yet to incur the expense. You say you are doing the project, go ahead and incur marketing expense. Not doing the project, don't incur marketing expense. Yes, incur. No, don't incur. Relevant. No, don't. Next, a company has incurred market survey of 10 lakh. Yes, already incurred. No, already incurred. Irrelevant. It is irrelevant. A new project has been apportioned. I'll tell you, our classes has been apportioned electricity cost of 100 lakh. Electricity cost include apportionment of what? General electricity charges, except to the extent of insurance charge of 10 lakh per annum payable on this venture. That is because of this classes, there is something extra which is happening. How much I got distributed? 100 lakh. I got distributed 100 lakh, and the question says factory overheads include apportionment of general factory overhead. If you just stop at this, no, zero is the relevant cost. Except to the extent of what? Insurance charge of 90 lakh payable on this venture. So if you do the project, cost is 100. If you don't do, cost is 10. Why 10? Because this 90 would not have been incurred. So 90 alone is specific. Tell me in this example, what will happen? How much is the initial working capital? 20 lakhs. In first year, what will happen? Outflow of 5 lakh. Second year, decrease to 22 lakh. Inflow of 3 lakh. From 25 minus 22. 3 lakh. Third year they can give, fourth year they can give, fifth year they can give. You can keep going on that. Company has invested 2 lakh in conducting a market survey to assess the response to a new product. In accordance with the survey finding, company wants to spend 10 lakhs on machinery, 4 lakhs on working capital. What is the initial outflow? On day 0, how much total we are paying? 2 lakh. Market survey? That's a sunk cost because doesn't really matter. You have already incurred it. Hospital is contemplating acquisition of a diagnostic machine which is expected to generate an after-tax cash flow of 80,000. Currently, I am outsourcing and earning a commission income of 20,000. Applicable tax rate is 40%. How much is the incremental CFAT due to the new machine? What is this 20,000? It is opportunity cost, because what used to do is when you were going to hospital, they're writing some scan and telling you to go to someone else. He was giving me commission income of 20,000. Now, because of this diagnostic machine, I'm going to earn 80,000. Opportunity cost is 20,000. How much is the CFAT? It's not 80,000 minus 20,000. I told you opportunity cost before tax, after tax. Wording used is what? Commission income of 20,000. They have never mentioned that this is before tax or after tax. Normally it is before tax. Normally it is. If I tell I earn a rental income of 1 lakh, you'll understand rental income is before income tax. So first I convert this 80,000 divided by 0.6. How much? 80,000 divided by 0.6. Subtract now 20,000. Now subtract tax. This is one way of doing. Other way of doing is 80,000 leave as it is. Convert the 20,000 into after tax. Convert the 20,000 into after tax, which is 12,000. Convert 20,000 into after tax, which is 12,000. So 80 minus 12, 68. 80 minus 12, 68. Go through this. You need to tell me as per your income tax understanding. Go through this and tell me as per income tax understanding. What does block of assets method say? Sorry? Entire block should be sold, otherwise no capital gain, no capital loss, unless the sale value of one asset is even more than the block value itself. The sale value of one asset is more than the block value. I am following a block of assets method. It has several other machines in the block, so block will not cease to exist. Block will not cease to exist. Company is selling an existing machine with a book value of 3 lakh for 5 lakh. I'm selling an existing machine of 3 lakh for 5 lakh. No income tax will come on this. No income tax will come on this because it is not short term capital gain. It will purchase a new machine for rupees 10 lakh. It will purchase a new machine for rupees 10 lakh. Just an imaginary number, okay? Today the block value is 100 lakh. Just an imaginary number. If somebody is saying no, block value is very less, then it's a different story. So in this 100 lakh, I'm selling an asset for how much? 3 lakhs asset for 5 lakh. From block 5 lakh will get removed. From block 5 lakh will get removed. It will become 95. And then in the block, how much will get added? 10. So block will now become 105. Block will become 105. All this is your income tax angle. All this is your income tax angle. No capital gain. No capital gain. So no tax payment and all. Why no capital gain? Very clear calculation. Because I do have other assets in my block. What is the extra depreciation? Earlier 100 lakh into 10%. Now 105 lakh into 10%. Now 105 lakh into 10%. So extra is how much? 50,000. Extra is 50,000. Nil tax paid and depreciation of 50,000. Company will not pay tax as there are other assets in the block. Incremental WDV is WDV will go up by 10 lakh, go down by 5 lakh, extra 5 lakh. On that extra 5 lakh, 50,000. Any doubts on this? Next, steps in computation of cash flow. When you calculate your cash flow, we normally follow 3 steps. Initial outflow, in between flow, terminal flow. Initial outflow, in between cash flow and terminal flow. What is initial outflow is capital expenditure and working capital. Some money is stuck in capital expenditure, some money is stuck in working capital. Apart from this, some question can say you got some subsidy income, you got some government grant, you paid some compensation. All this can happen on day zero. Whenever these extra happen, think income tax about it. Think income tax about it, because it may have tax impact. It may not also have tax impact. There may be some other items such as installation charges will not have any income tax impact, because installation charges will get added to the cost of the asset. If you pay any compensation, you may get tax benefit on that. You may get tax benefit. We should capture only the amount which has been paid on day zero in initial outflow. Sometimes what will happen is you bought a machinery worth 100 lakh but paid only 80%. Capital expenditure is only 80 lakh. Capital expenditure is only 80 lakh in day zero. Where will balance 20 go? In your in between cash flow. In your in between cash flow. In between cash flow, start with how much extra revenue you are making, how much extra cost saving. Any saving in cost is like a revenue. Any saving in cost is like a revenue. Deduct all cost other than depreciation or with depreciation. That's your wish. If you deduct without depreciation, it's called PBDT. Many a times what I do is I deduct even with depreciation and directly give PBT, directly give profit before tax. Then you deduct tax, profit after tax, add back depreciation, working capital changes, any new capex, and in case you have made any payment for your original machine. I said you would not write the entire amount there. So any extra amount you paid will come here. Incremental means only the extra revenue generated or extra cost incurred. This is because company would have earned some revenue even without the new project. As I said, because of this project, how much extra benefit, because of the CA classes, how much extra benefit is coming to you or to me needs to be measured and not the overall number. What is terminal flow? First is net salvage value of your capital expenditure, and second is recapture of your working capital. Every year working capital gets stuck. In the end, it will get released. In the end, it will get released. On the capital expenditure, what will happen is you will sell it. You will sell it. So on the capital expenditure, we'll have something called as sale value compare with book value. We have sale value compare with book value, that can result in capital gain or capital loss, on which there can be a tax paid or tax saved. And finally NSV. What is NSV? Sale value plus tax saved minus tax paid. Sale value plus tax saved minus tax paid. Example is a very important thing. Sale value is 1 lakh, okay. Book value is 50,000. I make a capital gain of 50,000. I make a capital gain of 50,000. On the capital gain of 50,000, we need to pay income tax at the rate of 40%, which is 20,000. What is NSV? Is this 1 lakh and this 20,000. Many students in a hurry think it is continuation and do 50,000 minus 20,000 and write 30,000. It's not continuation. There's a line gap in between. Your what is net salvage value? Sale value plus or minus tax. Sale value plus or minus tax. So 1 lakh minus 20,000. 1 lakh minus 20,000, you get 80,000. If both are same, no income tax, 50,000. Sale value 0, but still there can be a net salvage value. Sale value is 0, but still there can be a NSV. There can be a NSV because book value is 50. There's a loss 0 plus the tax saved. If sale value is equal to book value, there is no tax. Sale value is equal to NSV. Some question will say ignore tax on capital gain. Don't do any calculation. Sale value is equal to net salvage value. If sale value is 0, this does not mean NSV is 0. This does not mean NSV is 0. If resale value is equal to cost of removal, some question will say project got over. You want to sell the machinery. For selling the machinery, you will get 1 lakh rupee. But to take it out from your factory to outside, you have to spend 1 lakh. You have to spend 1 lakh transportation cost. So if resale value and cost of removal is same, sale value 0, net salvage value depends on the calculation. Net salvage value depends on the calculation. Do this example and tell me what is the initial outflow. Guys, please do calculation. I want you to do the calculation. Tell me what's the initial outflow. How much? ABC is considering replacing of its outdated machine with a new machine, which comes with a price tag of 5 lakhs. Existing machine will be sold for 1 lakh. So net 4 lakh. As part of the upgrade, all current utilities is related spares, which you will need another 2 lakh, and your old utility will be sold for 20,000. So net it is 5 lakh 80. Tell me this. This is in between flow calculation. My inflow is 2 lakh of saving and 4 lakh of saving. Outflow is 3 lakh. Depreciation 2 lakh. Profit before tax is 1 lakh. Profit before tax is 1 lakh. Deduct income tax. Profit after tax is 70,000. Add back depreciation. Add back depreciation. Do this. What's the answer? A machine can do two things. Either it can save cost or give you revenue. It is giving me a revenue of 5 rupees net. What is 5 is 20 minus 15, and also saving 2 rupees for me. Also saving 2 rupees for me. What is 2 rupees? I incur a cost of 2 per ton to dispose. 2 per ton to dispose. So I have saved 2 rupees, earn 5 rupees, put together 7 into 1 lakh. Put together 7 into 1 lakh. Some question will say asset is purchased at the beginning of the year. Our capital budgeting assumes everything to happen only at the end of the year. Does it mean everything will happen at the end of the year? No, this is just to do simple calculation, because the PVF which you use, no, that is the end of the year PVF. The PVF which you use is end of the year present value factor. Somebody says no, everything Jan, Feb, March, I cannot do all those calculation. So to make it simple, we do end of year calculation. Now, if you are buying anything at the beginning of the year, then purchase of asset at the beginning of year 10 is end of year 9. Write the cash flow in the 9th year. Write the cash flow in the 9th year. Capital budgeting assumes that cash flows will happen at the end of the year. However, some assets could be purchased at the beginning of the year, and these cash flows will be considered in the earlier year. Example, purchase of asset at beginning of year 5 is equal to end of year 4, is equal to end of year 4, and this cash flow will be considered in year 4. This cash flow will be considered in year 4. Impact of losses. Losses has some significant impact. Whenever an organization suffers loss because of a new project, I'm talking about a new project, not overall loss, okay? Because of a new project, it can save income tax for the company. How can it save income tax? If my other projects are making profits, I'll set off this loss against the other profits and reduce my tax outflow. Any reduction in outflow is an inflow for us. Any reduction in outflow is an inflow for us. Now, this tax saving can be in multiple ways. First approach, all businesses are loss making. All businesses are loss making. No tax saving immediate, but maybe carry forward to future and save tax in the future. Carry forward to future and save tax in the future. So either you can get immediate tax saving, or tax saving later, or you get nothing, Example, PBT first year negative 80, year 2 50, year 3 120, year 4 110. Tax rate is 30%. Loss of any year will be set off from the profit of subsequent 2 years. What is the PAT of year 3? Can you tell me how much income tax you will pay in year 3? This is the data. How much income tax you are going to pay in year 3? Minus 80 is there, 50,000 is gone, another 30,000 is still left over, that is written off. 90,000 is your profit of before tax. Taxable PBT is 90,000. On that you pay 30%, which is 27. This 27 will be subtracted from 120. My PBT does not go down. My taxable income goes down. My taxable income goes down. Some question will say a company has a tax exemption on 20% of profits, 40% of profits, 30% of profit. Two approaches. One is a lengthier approach, another one is a easier approach. What is a lengthier approach? Every year PBT, do a separate calculation, remove 20% from there and then apply. So PBT is 100, remove 20 from this, make it 80, make it 80 and then say 80 into 30% is income tax 24 and bring this 24 here. Second easier approach is my tax rate is not 30%. My effective tax rate is 30 into 1 minus the exemption percentage, into 1 minus the exemption percentage. See, your income tax rate could be different, my income tax rate could be different depending on the slab you are in. Similarly, some company may not be paying entire 25%. 40% of the profit is exempt. So their effective tax rate is 25 into 1 minus 40. 25 into 1 minus 40. If you do not pay any expense in the year of incurrence, doesn't really matter. For income tax, it is an allowed expense. So till PAT, no changes. Till PAT, no changes. If you do not pay anything, it is a current liability. It is a current liability. Current liability will come as part of working capital adjustment. Current liability will come as part of working capital adjustment. If you don't pay anything, your working capital will go down. How does working capital go down? Because working capital is current asset minus current liability. If you create current liabilities, working capital goes down. Any decrease in working capital is an inflow in our calculation. Is an inflow in our calculation. So automatically it will be considered there. Unpaid expense will be reflected as current liability and would be factored where? Working capital adjustment. Sometimes what happens is you get a subsidy or a grant from a government. You get a subsidy or a grant from a government. If government gives you a subsidy or a grant, there are two types of subsidy. One is capital subsidy and revenue subsidy. Revenue subsidy is considered in between cash flow, either before PBT or after PAT, depending on whether that subsidy is taxable or exempt. Capital subsidy is considered in step 1 initial outflow. You consider that, but it has one implication. The capital subsidy can be adjusted with the cost of the asset. If you adjust with the cost of the asset, lower depreciation in future. Lower depreciation in future. If you don't adjust with the cost of the asset, normal depreciation in future. Question will not clearly specify the treatment for capital grants and will have to take an assumption. If the grant is adjusted, then it will lead to lower depreciation expense. Clear? Any doubts on this? Any doubts till this? These are your basics which is covered in segment 1 and segment 2 in the question bank. If you see in those questions, I would not have marked revision. In the PDF you will see it's not there in your printed one, but I would not have marked the word revision there because they are not part of study material or the past exam questions. So those are CA inter question. Why I need clarity? Because capital budgeting is also there in international capital budgeting, in international financial management, and even in normal capital budgeting, ICI may end up testing on cash flow calculation. May end up testing on cash flow calculation. Now let's come to the final part of it. In that, ICI material had one thing called as concept of utility value. Problem is very simple. There's no major discussion needed. What they are saying is you're going to generate some cash flow. If you are generating some cash flow, what ideally I want to do is I want to calculate NPV, positive, go ahead, negative, reject it. They're saying no, for the cash flow I'll give a utility value. What is utility values? If utility value is high, it means it is more important for you. Utility value is less, it means it is lesser important for you. So they attach some utility value, attach some probability. Final utility value is weighted average of the various possible utility value with probability being the assigned weight. With probability being the assigned weight. Wherever probabilities are there, we have to take weighted average. Wherever probabilities are there, we have to take weighted average. So what ICI ended up doing is, let's see this. This basics of capital budgeting, there are lots of questions. I think you may have some 4 or 5 questions in this basics. All this for your better understanding. Investment decision, again all these are CA Inter question. I've just copied from CA Inter and moved it here. Maybe 1 or 2 question could be CA final, but predominantly everything is CA Inter question. Now why I want you to go through them, because in exam if some question comes like this, I don't want you to struggle there. I don't want you to struggle. So that's the reason. Okay, this is the question on utility value. Jumble Consultancy Group has determined the relative utilities of the cash flows of 2 forthcoming projects of the client company as follows. That is, if you generate negative 15,000, your utility is negative 100. Negative 10,000, your utility is minus 60. Project A, let's calculate. Utility value is equal to project A is equal to right. Project A is equal to minus 15,000 means how much utility value? Minus 100 into 0.1. Minus 10,000, what is the utility value? Minus 60 into 0.2. 15,000, what is the utility value? 40 into 0.4. 10,000, what is the utility value? 5,000, what is the utility value? I don't know why they want to even test something like this. That's all. You do a weighted average, you're done. Do a weighted average, you are done. This is called utility value calculation. This is called utility value. Project A 2, project B 17.55. Go ahead with project B. Go ahead with project B. Weighted average of the various possible utility values with probability being the assigned weight. With probability being the assigned weight. This is called expected utility calculation. Any doubts on this? Can you proceed? Okay, a small discussion again on FCFF and versus FCFE. We've already done this earlier also. FCFF discounts are technically called as long-term funds approach. FCFF is technically called long-term funds approach. FCF is technically called equity shareholders approach. FCF is technically called equity shareholders approach. Whatever FCFF you discount is at cost of capital called project NPV or project IRR. Project NPV or project IRR. FCFE is discounted at cost of equity called as equity NPV or equity IRR. Equity IRR or NPV can be better than project NPV or IRR if you are paying a lower interest. For example, project is earning 20%, and what you did is you're paying interest of 8%. You're paying interest of 8%. If project earns 20, you should pay 20 to all the three. 20 to all the three. Obviously, you will not pay 20 to the dead guys because they're taking lesser risk. So if you pay less to the dead guy, that extra 12 of theirs will go to equity. That extra 12 of theirs will go to equity. It will not exactly become 20 plus 12, but whatever you did not pay them, who's the residual beneficiary? Equity guy. And unfortunately, if project is generating 6 and debt you have to pay 8, whatever extra pays goes from the equity. Let's do this. This is a very good example. Compute FCFF and FCFE from the following information. FCFF and FCFE from the following information. I will start with FCFF calculation. Let's do FCFF is equal to my starting is 3 lakh PBIT. My starting is 3 lakh PBIT. No interest subtraction. No interest subtraction. So if you ignore interest, tax is 1 lakh 20. 40%. Tax is 1 lakh 20. deduct capital expenditure in a normal manner, deduct working capital increase. Loan repaid will not come in the calculation. Loan repaid will not come in the calculation. New loans taken will not come in the calculation. Equity dividends paid will not come in the calculation. So none of them is going to come in our calculation. So in FCFF, I'm ticking what I'm ignoring: interest, loan repaid, new loans taken, dividends paid. All these are ignored in FCFF calculation. What is the FCFF number? How much? 1 lakh? From FCFF, if you want, you can move to FCFE, or you do calculation from the beginning also. Let me see from FCFF, how do I move to FCFE? How much is the interest paid?
Sir, we will add depreciation also, no?
Oh, sorry. Add back depreciation. Sorry, add back depreciation. 1 lakh is the depreciation. 2,05,000. Add back depreciation. Sorry. Okay. Now FCFE is start with 2,05,000. What is the interest net of tax paid? Because you're not paying 50,000. Interest net of tax is how much? This is my first subtraction. This is my first subtraction. Then what is happening? Subtract loan repaid. Subtract loan repaid. Then new loans taken is inflow. New loan taken is inflow. New loan taken is inflow. Some students have a doubt why new loan taken is inflow. Simple. When loan repaid is outflow, new loan taken has to be inflow only. New loan taken has to be inflow only. FCFE can increase if you are taking extra loans. You are taking extra loans. 2,05,000. From 2,05,000, subtract 30, subtract 50 and add back 25. You get how much? 1 lakh. This is the lengthier calculation. This is a lengthier calculation. That was a shorter calculation. A lengthier calculation is presented here. That was a shorter calculation. Any doubts on this? Can you proceed? Okay. Next comes APV approach, adjusted present value approach. What adjusted present value approach says is, these are all, now we move to the final part of it. Utility was not very critical for me. AP onwards, everything becomes a little critical. Now what APV approach says is, you have a project. When you analyze the project, first analyze the project on a standalone basis without knowing what is the debt equity mix, without knowing what is the debt equity mix. So every project discount at unlevered cost of equity, discount at unlevered cost of equity. What is unlevered cost of equity? Is using the unlevered beta, using the unlevered beta, technically the project beta, technically the project beta. Levered beta is called equity beta. Levered beta is called equity beta. You did the analysis. You got NPV as negative 25,000. You got NPV as negative 25,000. Then they are saying, now I bring in benefits of debt onto the project. Benefits of debt onto the project. See, on a standalone basis, the project is not good. The project is not good. But if you borrow money because of tax benefit, maybe the project becomes better. Maybe the project becomes better. I'm not saying it will become better, but maybe the project becomes better. So they are saying, first you do base case NPV is calculated by discounting cash flow at unlevered cost of equity, at unlevered cost of equity. Then PV of debt financing benefit. Debt financing benefit can be in two ways. Okay, there are two things in question. One is the tax saving. Second, one problem what happened is, I was putting up a project in a backward area. In a backward area, let's assume I'm putting a project in a foreign country. In a foreign country, normally the rate of interest on a loan is 8% for me, but that country is saying we'll give you at 6%. So I save interest of 2%. I save interest of 2%. One is tax saving. Second, the normal interest itself can get saved. The normal interest itself can get saved. Both will have to be factored in debt financing benefit. Both will have to be factored in debt financing benefit. PV of debt financing benefit comprise of tax saving plus lower interest rate due to some subsidy. Due to some subsidy, this needs to be discounted at what? In case of perpetual debt, we did this in the valuation of distressed company. In case of perpetual debt, the tax benefit is equal to amount of debt into tax rate. PV of issue cost. What is PV of issue cost is, first you did a base case NPV, you subtracted, you added the debt financing benefit. If I have to do a project, for doing the project, I need to raise debt and equity. For raising that, you may have to incur some underwriting costs, flotation costs, some commission, all that. So that please subtract in your NPV calculation. Please subtract in your NPV calculation. Now in that, there can be an assumption needed that the issue cost is there. No, you may incur only on debt, or you may incur both on debt and equity. That depends on your assumption. A company is taking a loan at the rate of 4%. Their normal interest rate is how much? 7%. So 3% saving. 3% saving. Normal interest rate is 7%, but I took a loan at what? 4%. So I have a saving of how much? 3%. Loan is for a period of 5 years. So every year I'll be saving 3%. Loan amount is 10 lakh and repaid at one stretch after. This is a very important information. Otherwise, every year you have to calculate the loan amount. Every year you'll have to calculate what is the interest saving, what is the tax saving, and then do discounting. One stretch means every year same amount. So every year I am going to save 10 lakh into 4% into 30%. 10 lakh into 4% into 30%. What is 30%? Is the income tax. Apart from that, 10 lakh into 3%. What is 10 lakh into 3% is, you are going to save 3% lesser tax. You're going to pay 3% lesser tax. So wherever you're doing NPV analysis, you will add 170 to 200. We'll see this in a problem in 2-3 minutes. You will save 1,70,000 to 200. Able to understand this? Let's see this in a question now. I'll come to replacement decision later on. Page 43, question 30. 44, question 30. Go through this. Go through the question. Okay. Last line very clearly says they want us to follow APV method to analyze the project. What is APV method? Is base NPV plus any tax saving minus any issue cost if at all there. Initial investment will in the purchase of equipment costing USD 250 lakh. Economic life of the equipment is 10 years. Depreciation will be charged on straight line method. Economic life means you can charge depreciation only for 10 years. After that, depreciation cannot be charged. Why after that? Because this is there for how many years? 20 years. EBITDA from the toll road will be 33 lakh per annum for a period of 20 years. To encourage investment, let's ignore this data for the time being. This is the debt financing benefit. Required rate of return under all equity financing is 12%. So first we calculate base case NPV using 12%, using 12%. Then we will bring the concept of debt financing benefit. We'll bring the concept of debt financing benefit. Working note 1, computation of base case NPV. Computation of base case NPV. Note 1, computation of cash flow. Particulars year 1 to 10, year 11 to 20. Why segregation? Because first 10 years you can charge depreciation, then you cannot charge depreciation. One to 10 and 11 to 20. EBITDA. EBITDA. How much is EBITDA? 33. I think crores, I think, or lakhs, what it is. Okay, take a lakhs. 33. Right hand side corner, you can write lakhs. Less depreciation. Interest will anyway not be there because we are using APV approach. APV approach, equity means it's full equity finance. Base case is full equity finance. And even if you use long term approach, interest is not subtracted. How much is the depreciation? EBT, earnings before tax. Earnings before tax. Less tax at what rate? EAT. Add back depreciation and CFAT. EAT, add back depreciation and CFAT. Clear? Any doubts on this? Done? Can you proceed? Working note 2, computation of, sorry, or note 2, computation of NPV, computation of base case NPV, year, cash flow, PVF. What is the cost of equity? 12%, DCF. Year, cash flow, PVF for 12% DCF. Year 0, 1 to 10, 11 to 20. 1 to 10 and 11 to 20. What's the year 0 outflow? 30.6. See, they have given the factor for 1 to 10 and 1 to 20. Annuity factor is 1 to 10 and 1 to 20. Listen, from 1 to 20, if you subtract 1 to 10, you will get 11 to 20. You will get the factor for 11 to 20. So 5.650, 5.650, 7.469 minus this. So it is a bad project on a standalone basis. It's a bad project on a standalone basis. Only the debt part can save this project. Only the debt part can save this project now. On a standalone basis, it is a bad project. Maybe debt comes to its rescue. Debt comes to its rescue. Any doubts till this? Can we proceed? Then computation of tax benefits on debt. Year, cash flow, PVF, DCF. My printed solution has a different way of calculating. I'm going to now do a different way of calculating. Net and answer will match. Year, cash flow, PVF, DCF. Question has given post-tax cost of debt. Please convert that into pre-tax cost of debt. Question has given post-tax cost of debt. I want pre-tax cost of debt. PVF at 8%, 5.6. Pre-tax is equal to 5.6 divided by 1 minus 0.3, 8%. Now government is saying you come and do project here. You come and do project here. We'll give you what? A 15-year loan on USD 150 lakh at what rate? 6%. The loan will be repaid at the end of 15 years in one tranche. That's the most important data. Otherwise, every year you have to do the calculation. Every year you have to do the calculation. So I have two savings. One is whatever interest I pay. How much is the annual interest I'll pay? Amount 9. So first write 1 to 15. 1 to 15 tax saving. This is the tax saving. 1 to 15 tax saving is 150 into 6% into 30%. 150 into 6, whatever rate we are paying. Whatever rate we are paying into 30%. Into 30%. 150 into 6% into 30%. That's the first benefit for me. Second benefit, government is saying, don't worry, I do you one more thing. Interest itself, I will save you. I wanted a loan at 8%. Why 8%? Because my cost of debt is 8%. Government is giving loan at what? 6%. So listen, the second saving is 150 into directly 2%. Into directly 2%. If the amount was getting repaid every year, you will have to do this calculation. Every year you will have to do this calculation. 8%, 15 years, not 20 years. Only benefit is for 15 years. The factor is there in the question. 8.559. Printed solution, I have done it in a different manner. Net the answer will match. Net the answer will match. Again, I'll repeat what APV approach says is consider two things. One is any tax saving on interest you paid, and second is any interest itself saved. Any interest itself saved. The same calculation I think is presented differently here. Here I have presented it slightly differently. Net it is same 48.828. We got 48.7863. Both will give you same answer only. This is another way of presenting. I'll explain this also. What we are here we have done is I have done calculation based on my cash flow directly. Done calculation based on my cash flow. What is my cash flow? I took a loan of 150. I paid interest of 9. I saved tax of 2.7. I repaid 150. I discounted this at 8%. My net saving is 48.828. My net saving is 48.828. This is proper my cash flow. This is my proper cash flow. Took a loan, inflow, paid interest, outflow, tax saved, inflow, repaid amount, outflow. Net calculation is 48.828. 48.828, or I have presented it this way. Both are same, rounding of difference. Okay, it's only the rounding of difference. And when you add them together, project becomes a very good project. Project becomes a very good project. Clear? Any doubts on this? I'm not discussing other questions on APV because they are not part of your study material and all. I'll discuss only questions which are part of your study material or which have come in the recent attempts. So other questions you can go through them for your practice. They are for your practice. Any doubts on this? Can we proceed? Again, I'll repeat, there are two benefits which an APV approach can give. One is the tax which you save. See, one more angle has to be brought in, which is this. Issue cost. There can be an issue cost which needs to be subtracted in the calculation. What is issue cost is when you raise a project, on that you have to spend some money. I think this question also has an issue cost. At home when you practice, maybe there's an issue cost even in this question. So issue after tax cost of issue is expected to be 10 lakh. So issue cost is considered in APV approach, not in the normal. It's ideally even in the normal approach we consider it, but we don't take there. We start with base case analysis, because what happens in base case analysis is I don't want to look at how you are raising money. What APV approach says is investment is separate, financing is separate. Don't try to mix them together. Moment you mix them together, you will end up making wrong decision. So in our initial outflow, you'll always see capital expenditure, working capital. Nowhere you would have seen that to raise that money, I need to pay 5 lakhs issue expenses or 10 lakh issue expenses, because we don't mix them together. We don't mix them together. That is separate. This is separate. Project is good, great, fund it. Project is bad, sees if debt can help it. If debt can help it. Any doubts on this? Next comes the EAB or EAC approach. Now, what is this EAB or EAC approaches? I'm analyzing two projects with unequal life. With unequal life. That is, project 1 has a life of 10 years. Project B has a life of 5 years. You are deciding which is a better project. You are deciding which is a better project because you wanted to buy machine A or machine B. We will see two types of problems. One where only outflows are given, no data on inflow. Second type of problem where only inflows are given, or inflows and outflows both are given. If only outflows are there, and if you calculate NPV, it will be negative, obviously. It will be negative, obviously. So if only outflows are there in a project, we calculate something called as PV of outflow. We calculate something called as present value of outflow. And if both are there, we calculate something called as NPV. We need to divide this PV of outflow or NPV by annuity factor. By annuity factor and not number of years. Divide by annuity factor. That is, you earn 2 lakh in 2 years. Does not mean you earn 1 lakh per year. Does not mean you earn 1 lakh per year, because 2 lakh in 2 years, considering the time value of money, the number will change. Considering the time. For example, I tell you, give me 2 lakh today. I'll repay 1 lakh every year. You will not accept. You will say you have to give me something extra. You have to give me something extra. That something extra is time value of money. That something extra is time value of money. Can you tell me 2 years 10% annuity factor? 2 years 10% annuity factor. 1 point. Okay. Assume I take 2 lakh from you. 2 lakh divided by 1.735 is how much? So technically 2 lakh earning NPV is earning equivalent of 1 lakh 15,000 every year. Is equivalent of earning 1 lakh 15,000 every year. Don't tell me it's equivalent of earning 1 lakh every year. That's not the right approach. It's equivalent of earning 115 every year. So divided by what? Present value annuity factor R comma life. Present value annuity factor R comma life for EAC as well as EAB. In EAB we use NPV. In EAC we use PV of outflow. You want to use NPV also, use it, but it will be having negative number. So negative number indicates it's PV of outflow. That's all. Negative number indicates it is PV of outflow. Obviously, I will select a project with higher EAB, lower EAC. Select a project with higher equated annual benefit, lower equated annual cost. Example, company is selecting two mutually exclusive projects. Both projects can be repeated indefinitely. What is repeated indefinitely? Is EAB or EAC assumes this. If you are going to earn 20,000 in 3 years and this is 25,000 in 5 years. So what I can do is I will start with project A. Do it once, 3 years over. Do it again, another 3 years. Do it again, another 3 years. Do it again, do it again. So as you keep repeating, let's assume 15 years got over. Let's assume 15 years got over. Ignore the time value of money for the time being. Let's assume 15 years got over. Project A would have repeated 5 times in 15 years. Would have repeated 5 times in 15 years and earned 5 into 20,000. Earned 5 into 20,000. Project B, you would have repeated only 3 times in 15 years. You would have repeated only 3 times in 15 years and would have earned 25,000 into 3. So that is why just the absolute amount is of no use. Some question says you cannot repeat it itself. You cannot repeat it. Then NPV is what makes sense. Then NPV is what makes sense. See, if I'm going to do project A, I earn 20,000 and I cannot repeat it. Let me earn 25,000. Let me earn 25,000. Why should I earn 20,000? Why should I earn 20,000. Let me earn more. Let me earn more. EAB and EAC inherently assumes that you will keep repeating it. You will keep repeating it multiple times. You will keep repeating it multiple times. Tell me the 3-year and 5-year annuity factor. 12% 3 years, 12% 5 years. 2.402. 3 decimal we normally take. And you need to divide. You will get 8326, you will get 6935. I will go ahead with selection of project A. I'll go ahead with selection of project A because project A has better EAB. Project A has better EAB. Earning 20,000 in 3 years is better than earning 25,000 in 5 years. It's not direct divide by 3 divide by 5. You need to consider time value of money. You need to consider time value of money. Let's come to 21. Let's come to 21. Page 36, 21. Go through the question. Okay. ABC Limited need to choose between two machines. They are designed differently, identical capacity to exactly the same job. Machine A will cost 1,50,000, will last for 3 years. It will cost 40,000. Machine B economy model cost 1 lakh, will last for 2 years. Ignore tax. Ignore tax is a very important word. If you ignore income tax, you will have to ignore depreciation, you will have to ignore tax saving on expenses, everything. Opportunity cost of capital is 10%. Which machine is better? In this question, I do not have any data on inflow. I do not have any data on inflow. I'll do my calculation like I do normal NPV calculation, but I'll call it as PV of outflow. Working note 1, project A, evaluation of machine A, year, cash flow, PV of a 10%, DCF. Year, cash flow, PV of a 10% DCF. How many years is the life of the machine? Year 0, 1 to 3. What's the initial outflow? Negative 150. Negative 150. 1 to 3, what is the outflow? Negative 40,000. In the answer, I've written positive, don't worry about it. Negative 150, negative 40. Tell me the 3-year annuity factor. PV of outflow. PV of outflow. Why I use the word PV of outflow? Because I don't want to use the word NPV. Then you may say it's a negative NPV. It's not negative NPV, it's PV of outflow. Then EAC. EAC is PV of outflow divide by annuity factor PVAF 10%, 3 years. Annuity factor for 3 years. Divide by annuity factor for 3 years. 249, 480. Please, at the EAC stage, don't put a sign, don't put a negative sign there. Annual cost means it is negative only. So don't put a sign at this stage alone. Okay. So this divided by 2.487. 1 lakh rupee every year I have to incur. 1 lakh rupee every year I have to incur on machine A. 1 lakh rupee I have to incur every year on machine A. Why I have done EAC? What is the life of machine B? 2 years. So I know that. So I've already done the EAC. Else we repeat it, else we do it in the end. Any doubts on this? Then comes the machine B, same table. Evaluation of machine B. Evaluation of machine B. Machine B. How many years is the life? 1 to 2. 1 to 2. Cash price how much? 1 lakh negative. Negative 60,000. Tell me the annuity factor for 2 years. 73. 117604 is the EAC. 117604 is the EAC, equated annual cost. One lakh 17,604 is the equated annual cost. Any doubts on this? Life is different. We need to do EAB or EAC. Life is same. Directly go by NPV or PV of outflow. Same question. Any doubts till this? Same question. If you say consider income tax, let's take example. Tax is 30%. Makes a lot of changes in the calculation. Okay. 1 to 3. I'm just explaining machine A. 40,000 we are paying. Tax saved in every year is 50,000 of depreciation. 50,000 of depreciation every year. I'm talking about tax saved is 50,000 of depreciation, 40,000 of expense, 90,000 is your loss. 90,000 is your loss. When I say it's not loss, there are other businesses of the company. 90,000 depreciation is 50,000, cost is 40,000, tax saved 50 plus 40 into 30. So please add 27,000 in the calculation. Please add 27,000 in the calculation. Please add 27,000 in the calculation. If you consider income tax, what will be the tax saving of machine B if you consider income tax? 30%. 33,000, because depreciation there also 50 only. Depreciation there also 50,000 only. Plus you have to add what? Cost of 60,000. On that you save income tax. I expect ICI to add this twist in this type of a question where you have to consider income tax. Any doubts on this? Clear? Can we proceed? In my calculation, I've written everything as positive. I don't want to do that because I've seen some students struggling with this positive, negative, outflow negative, inflow positive. In the end, at the last step, please take care of the sign. Please take care of the sign at the EAC stage. Any doubts on this? Okay. I will have to discuss EAB, EAC extensively again when I do replacement discussion. Next is abandonment decision. Now, what is abandonment decision? Is deciding whether to give up an existing asset. Deciding whether to give up an existing asset. Lot of people think when to buy a new asset. Should I replace a new asset? But one important decision is when should you give up an existing asset? Just to give an example. You could be using a two-wheeler. Now, on the two-wheeler, as you start using it, after maybe 4 years, 5 years, 6 years down the line, every year, your annual servicing expense keep going up. So you need to put a stop at some stage saying that I need to abandon this now and buy a new one. So for abandonment decision, one, it can be done along with replacement. That's a separate analysis. Only abandonment if you have to analyze. Step 1, initial outflow. What is initial outflow? Is net salvage value of that two-wheeler today. Net salvage value of the two-wheeler today. What is net salvage value? If you sell the two-wheeler today, you would have got 40,000. But if you use it and sell it later, you will get more. You will obviously get less, but there's a time period. So abandonment is deciding whether to sell the car today or use it for another 2 years and then sell it. That's a decision you're trying to take. That's a decision you're trying to take. If you sell the car today, you earn NSV and your working capital also gets released. Your working capital also gets released. Now, abandonment says, let's analyze when I do cash flow. I assume that I'm continuing. I assume that I am continuing. If I continue, both of these are my opportunity cost. Both of these are my opportunity cost. I lose the benefit of selling the car for 2 lakh and I also lose the working capital. I also lose the working capital. What will you get? You will get your in between flow, revenue, expenses, PBDT, depreciation, PBT, tax, PAT, add back depreciation, CFAT, all that you will get. And after few years, you will sell the car. After few years, you will sell the car. That time you will get again an NSV. Again you will get an NSV. You calculate the NPV of this. NPV positive, continue with the car. NPV negative, sell the car immediately. NPV negative, sell the car immediately. NPV positive, continue with the car. NPV negative, sell the car immediately. Clear? Any doubts on this? Let's take an example. A company is re-evaluating the decision to continue with an existing machine. The decision to continue with an existing machine. The machine was purchased for 20 lakh 3 years ago, depreciated based on economic life of 8 years, SLM method. Machine can be sold today for 10 lakh. Tax rate on business profit, capital gain. How much is the opportunity outflow related to old machine today? I want you to calculate NSV of the machine on day 0. What is NSV? Sale value of the machine. Compare with book value of the machine. Capital gain or capital loss. Tax paid or tax saved. NSV. If you sell the machine today, what is the sale value? Can you tell me what will be the book value of this machine? You purchase for how much? 20 lakh. What was the life? Every year 2 lakh 50 you are knocking off. Every year 2 lakh 50 you were knocking off. How many years got over? 3 years. So your left book value is 12 lakh. This is going to lead to loss. On this loss, you have to save tax at capital gain. Tax or capital gain or capital loss, whatever. The income tax on this is only 20%. Business profit 25. Capital gain 20%. So tax saved is how much? And my NSV today is 10 lakh 50. Now what does 10 lakh 50 mean is, if you decide to continue with the machine, this is an initial outflow in the calculation. This is an initial outflow in the calculation. Why did you decide to continue? I'm not getting into it. Whatever be your logic, if you decide to continue with the machine, this is an opportunity cost on day 0. An opportunity cost on day 0. 10 lakh 50,000 is your initial outflow. Now comes the most important discussion. On this, I have a lot of problems to do. Replacement decision. What is replacement? Is selling an existing asset and buying a new asset. So unfortunately, you have to do old machine analysis, new machine analysis, and do an incremental analysis. Old separately, new separately, incremental. Even in a normal problem, also you do incremental, but there will not be two machines data given. For example, I told that if I do this batch, what is the extra benefit? So in your mind, you're doing old, new, but there's no old separate analysis and new separate analysis. But in a replacement, there'll be data for old machine, there'll be data for new machine, and you have to say what is extra depreciation, what is extra revenue, what is extra cost. So keep doing this extra calculation. For doing that, there are multiple approaches to do. So first is under replacement, we are deciding whether to replace an existing asset with a new asset. Cash flow for a replacement decision will be done by comparing existing machine with the new machine. Our calculation is new minus old. New minus old. Example, capital expenditure of new machine is 1 lakh. NSV of existing machine today is 20,000. So on the new machine, your outflow is 1 lakh. On the old machine, opportunity outflow is 20,000. Extra is 80,000. This is one way of understanding. The easier way of understanding, which I don't want you to know, the easier way is you will buy the new machine for 1 lakh, sell the old machine for 20,000. Your outflow is 80,000. Your outflow is 80,000. But understand the logic is new minus old. New minus old. Old machine will give you 5 lakh. New machine will give you 8 lakh. Extra 3 lakh. Extra 3 lakh. Old machine terminal value something, new machine terminal value something, again do new minus old, again do new minus old, and finally you will get NPV of the, you will have to keep doing new minus old, new minus old, new minus old at every step, every step. Can you please do this and tell me? Analyze new separately, old separately. Please analyze new separately, old separately. Analyze new machine separately, old machine separately. Don't link them together. And when I say new machine, capital expenditure can also be there, working capital can also be there. What is the capital expenditure of the new machine? 10,000. Okay. Working capital, how is it 4,000? Inventory increases outflow, accounts payable increases inflow because it's a current liability. It's a current liability. So working capital is 2,000. Old machine NSV calculation, sale value is 6,000, book value is 2,000, capital gain is 4,000, tax paid is 1,000, NSV is 5,000. This is 12,000 outflow. This is 5,000 opportunity outflow. 12,000 outflow and 5,000 opportunity outflow. Net difference is 7,000. Net difference is 7,000. New minus old. There's a lot of calculation presented there, but keep in mind new minus old. New minus old. Okay. Any doubts? Before I start doing questions, let me quickly do 21. Then I take a small break and then I start doing the question. Let's come to this 21. There are 3-4 types of replacement decision questions we are going to do. 3-4 types of replacement decision. First is whether I should replace an existing machine with a new one. For which what you need to do is old separate analysis, new separate analysis, and do new minus old in every step. Do new minus old in every step and get the incremental cash flow. Calculate incremental NPV, positive, negative, positive, negative. Second is I'm yet to buy a machine. I'm yet to buy a machine, and question says what is the optimal life of the machine? You're yet to even buy the machine, and question says what is the optimal life of the machine? So what you need to do is, if you buy the machine and use for 1 year, what is the NPV or PV of outflow, and do EAB. Do EAB or EAC. That is, use machine for 1 year, 2 year, 3 year, 4 year, 5 year, whatever is the number of years. The life is 4 years, let's assume. If the life is 4 years, calculate what is the EAB if you use it for 1 year. What is the EAB if you use it for 2 year? What is the EAB if you use it for 3 year? What is the EAB if you use it for 4 year, or EAC? Or EAC, whichever has the highest EAB or whichever has the lowest EAC is the optimum life of a car. Let's assume a car has a life of 10 years, but that does not mean you need to use it for 10 years. Maybe the optimal life is 6 years. The optimal life is 6 years. Assume a potential asset of 4 years. Compute NPV, example is 4 years, okay? RPV of outflow for 4 alternatives: 1 year life, 2 year life, 3 year life, 4 year life, and then do EAB or EAC and decide which is the best. Decide which is the best. Your ICS study material has 3-4 questions on this area. Has 3-4 questions on this area, deciding what is the optimal life. What is the optimal life? Then what's the third category? You have already decided that you want to replace a machine. You have already decided that you have to replace a machine. So approach one will not work, saying whether I want to calculate NPV, when to replace and all. Here I want to know when should I replace. When should I replace? So then what I do, let's assume a life is 2 years. Balance life is 2 years. Let's assume a scenario, balance life is 2 years. My first calculation is, if I replace immediately, immediately what is the NPV or PV of outflow. If I replace at the end of year 1, what is the NPV or PV of outflow? If I replace it at the end of second year, what is the NPV or PV of outflow? And then finally, if you want, you can take EAB or ESC help. ICI at one place did not do it. I'll explain as we proceed. And then ultimately decide. So three type of question. One, I have an existing machine. I want one answer from you. Should I replace or not? Second, I'm planning to buy a car. Tell me, should I use it for 1 year, 2 year, 3 year, or 4 year? Third, I have an existing car. I want to buy a new car. I want to buy a new car. Don't tell me whether to buy or not. I have decided I want to buy. You tell me, should I buy now, wait for 1 year, or wait for 2 year? That is the answer I'm expecting from the you. So three types of question. First question is, I have an existing car. Should I replace it or not? Please give me an answer to that. That is type 1. Second, I'm planning to buy a car. Tell me, should I use it for 1 year, 2 year, 3 year, or 4 year? Third, I've already decided that I'll replace the car. Don't tell me whether to replace or not. I know I have to replace. You just tell me when should I replace. When should I replace? Clear? Any doubts on this? Let's take a 10 minutes break and then resume. Okay, so I was discussing on replacement decision. I'll again quickly summarize it and then we start doing questions on replacement. In replacement, we have three types of question. One, to decide whether a replacement is needed or not, which is through NPV approach. Second, if you have already decided that you want to do replacement, then you need to decide the timing of the replacement or the optimum life of replacement, which will mostly be through EAB or EAC approach, which will mostly be through EAB or EAC approach. Let's see a few questions on this. Most of the ICA material questions are straightforward, simple ones. Some questions I've added from CA Inter. Let's come to 14. A company named Robbie's Cube decided to replace the existing computer system of their organization. Original cost of old system 25,000, installed 5 years ago. Current market value is 5,000. Depreciation on the old system was charged with a life of 10 years with an estimated salvage value is nil. Depreciation of the new system will be charged with life of over 5 years. Present cost of the new system is 50,000. Salvage value of the new system is 1,000. Cost saving with the new system 5,000. Increase in sales is assumed at 10% per year based on original total sales of 1 lakh. Company follows SLM method of depreciation. Cost of capital is 10%. Tax rate is 30%. Advise whether the company should go ahead with replacement. Category 1 question. Should you go ahead with replacement is category 1 problem. Go through the question. Go through the question. We'll analyze old separately, new separately. Okay, here I need to decide whether a replacement is needed or not. So I'll be doing particulars, new machine, old machine, and once that step is done, incremental will be calculated. First, we'll do initial outflow where you'll have capital expenditure and working capital for new machine. For old machine, you will have working capital and net salvage value today. Net salvage value today. Then in between flow, then terminal flow, consolidate and calculate NPV. Working note 1, initial outflow. Working note 1, initial outflow. Particulars, new machine, old machine. New machine and old machine. new and old. Point number one, capex, working capital, and NSV on day zero. Today we are analyzing NSV on day zero for the old machine. NSV on day zero for the old machine. Read question and tell me what is the capital expenditure of the new machine. Any working capital data given? No working capital. NSV calculation. NSV calculation. Particulars, amount, sale value, book value. First let's do them. We'll know whether there's a capital gain or a capital loss, and then accordingly do tax paid or tax saved and close it. What is the sale value of the old machine today? How much? When did you buy old machine? 5 years ago. For what price? So listen, 25,000 was the purchase price. We were charging depreciation assuming a life of 10 years. Assuming a life of 10 years. So every year 2,500 was the charge. Every year 2,500 was the charge. So minus 2,500 into 5 years already over. 2,500 into 5 years already over. We purchased it 5 years back for 25,000. Every year 2,500 we were charging. So in our books, the leftover value is how much? Capital loss. Capital losses. Tax saved. What is the tax rate? Sorry. Okay. Take it now. I was just searching because some question will use the word ignore tax on capital gain. Some question will use the word ignore tax on capital gain. Then you need not do this calculation itself. Then you need not do this calculation at 30%. So tax saved is how much? And NSV is sale value plus or minus tax paid or tax saved. So sale value is 5,000 plus 2250. This is my opportunity cost today. This is my opportunity cost today. Our other way of understanding is you buy the new machine for 50,000, sell the old machine for 7250. Sell the old machine for 7250. So total outflow. Total outflow. Incremental. Incremental outflow is new minus old. Minus 50,000 minus of minus 7250. 42,750 is my outflow. 42,750 is my outflow. Any doubts on this? Working note to in between flow. Particulars new old incremental. New old incremental. Minus of minus positive it has become, that's all. Why will it be positive? As I said, when I analyze old machine separately, it is my opportunity cost. When I analyze my old machine separately, it is an opportunity cost for me today. It is an opportunity cost for me today. That's why minus of minus became positive. What is the benefit of this new machine? There's a saving of 5,000 and there's a revenue increase of 10,000. There's a revenue increase of 10,000. Old machine, I don't know what is going to happen. So let me not worry about the old machine. Let's keep old separately, new separately. So point number one, cost saving. Cost saving 5,000, 0. Cost saving 5,000, 0. Revenue increase 10,000 and 0. Revenue increase 10,000 and 0. See, I can club them together and do as a single table also. Let me first complete the separate table, then I'll tell you if I clubbed is easy to do here. It's easy to do here. What's the depreciation of the new machine? What is the salvage value of the new machine? So 50,000 minus 1,000 divided by 5 years. 50,000 minus 1000 divided by 5 years. Assuming you had continued with the old machine, assuming you had continued with the old machine, what is the depreciation of the old machine? 25,000 divided by 10 years. 25,000. See, you will have to imagine as if you have continued with the old machine. That is how we work out category 1 question. Category 1 question, assume as if you are continuing with the old machine, assume as you have replaced the new machine. So this new is assuming replacement is done, old is if you had continued. If you had continued, depreciation is PBT. I'll show you the ICI answer, which is easier to understand, but I want you to do this way only, so that you first get a grip of the cash flow and then you do whichever approach is comfortable for you. What's the tax rate? If you have loss, you save tax. If you have profit, you pay tax. PAT. Add back depreciation. CFAT. Add back depreciation and CFAT. In short, old machine has only one thing, depreciation into the tax rate. Old machine has only one item, which is depreciation into the tax rate. They don't have anything else. They don't have anything else because no cash flow was given. No cash flow was given. What ultimately matters to us is extra. What ultimately matters to us is extra. What is the extra? 13,440 minus I'll be writing only 12,690. I'll explain again. I do new machine separately, old machine separately, and find out the incremental. Somebody says, no, I'll directly do incremental. That is also okay. What is directly incremental? Cost saving 5,000, revenue increase 10,000, depreciation increases 7,300. Depreciation increases 7,300. Directly you get 12,690. Directly you get 12,690. Few question I prefer do new separately, old separately, and then find the difference. Few question I prefer to do incremental directly. When to do incremental directly, when to do separately, that's your wish, provided, for example, for new machine they give 10 cash flows, old machine they give 10 cash flow. Doing separate analysis is easier rather than doing one directly the incremental. This question, direct incremental is easier. Directly the incremental is easier rather than doing new separately and old separately. That's a call you can take. Would the answer be different? No, answer is going to remain same. New 13,440, old 750, extra 12,690, or directly extra 12,690, or directly extra 12,690. Whichever way you do, that's your wish. Working note 3, terminal flow. I prefer to do always new separately, old separately. It ensures that I don't make an error. NSV, recapture of working capital, and total terminal flow. Working capital anyway is not there, 0, 0. For NSV, you will have to repeat this format, sale value, book value, and all. Particulars, old, new, and then I get incremental. Sorry, new, old, particulars, new, old, and then I get incremental. Okay, coming to this, what is the sale value of new machine after 5 years of life? 1,000. Book value is also 1,000. How it is 1,000? 50,000 minus 9,800 into 5. Moment both are same, you need not do any calculation. Moment both are same, sale value in NSV same, sale value in NSV same. Initial 2-3 question you should do this calculation. Later on in your mind, if both are same, Copy the sale value as NSV. Copy the sale value as NSV. Now wait. Assuming you had continued with the old machine. See, old is always assuming you had continued. You had continued. At what value will you sell the old machine after another 5 years? Nothing is given, so it is 0. Book value is also 0. Why book value is 0? Because it's fully depreciated. It is fully depreciated. So my capital loss is 0. Tax payment is 0. NSV is equal to sale value. NSV is equal to sale value. Again, I'm repeating, do old separately, new separately. Don't try to club them together. Clubbing them together can lead to certain complications in exam scenario. I'll show you a complex question where you will not do calculation. You will be in listen mode, but I'll show you a complex question where new separately, old separately. How does it help? Only thing you need to do is, old means you have to imagine that you are continuing with the mission. Old means you have to imagine you are continuing with the mission. So NSV is 1000. Terminal incremental. Now what you need to do is, whatever incremental you calculated for that NPV, what is the incremental initial outflow? 42,750. 42,750. What was the incremental in between flow? 12,690, and terminal flow is 1000. For this we need to calculate NPV. For this we need to calculate NPV. Next, computation of NPV. Year, cash flow, PVF. But what is the discount rate given? DCF. Year 0, 1, 2, 5 and 5th year. This is type 1 problem where I don't know whether to replace or not. Where I don't know whether to do replacement or not. Year 0 was negative, how much you said? And then 12 and then 1000. Give me the annuity factor, 5 years. 3 point. Positive, go ahead with replacement. This is more of a formality. Positive, go ahead with replacement. Negative, reject the replacement. Positive, go ahead. Negative, reject it. Why it's 42,500? Is it 42,500? Okay, there's a typing error here. 42,750. There's just a typing error here. See here, I did not do old separately, new separately. I clubbed them together. I clubbed them together. It is your convenience whether you want to club them together or you want to do them separately. Only thing is, control needs to be there on the numbers. Control needs to be there on the numbers. Any doubts on this? Again, I'll repeat only one important factor. You have to evaluate new machines separately, old machines separately for category 1 question. For category 1 question. And when you evaluate old machine, you will have to imagine that you are continuing with the old machine. You imagine you are continuing with the old machine. Any doubts on this? Let's look at the next question. Go through 15. Go through the question first. Let's decide which category the question is and then we start doing it. Most of the numbers are readily available. You may not find it very difficult now. Okay, a company has an old machine having a book value of 0, which can be sold for 50,000. If you sell for 50,000, capital gain 50,000. Capital gain 50,000 because book value is 0. Company is thinking to choose one from the following two alternative. One is incur extra cost and upgrade the machine. 10 lakh you will have to incur on upgradation. Second option is replace the old machine with a new machine, which will cost you 20 lakh 50, which will cost you 20 lakh 50. If you do upgradation, you cannot sell the old machine. If you do upgradation, you cannot sell the old machine. And if you do purchase the new machine, you will sell the old machine. So purchase of new machine will have a benefit of sale of old machine. What is the NSV of the old machine? Sale value less book value, capital gain, capital loss, tax paid, tax paid. Please calculate, guys, calculate. NSV of the old machine. What is the sale value of the old machine? Guys, participate. Sale value 50,000. Book value, capital gain, 50,000. Capital gain 50,000. Tax paid is 40% of 50,000, which is 20,000. Leave a line. NSV sale value minus the tax paid. So this is, I don't need a lot of calculation to be done. So be in listen mode. When calculation is needed, I'll let you know. If you buy the new machine, your outflow is 20 plus 50 minus 30, which is the replacement decision. Replacement is new minus old. Replacement is new minus old. 20 plus 50 minus 30,000 minus 30,000. So replacement is 20 lakh 20,000. If you continue with the existing machine, outflow is 10 lakh. Outflow is 10 lakh. No opportunity cost. Don't bring opportunity cost because that benefit is given in the replacement. The 30,000 benefit is given in the replacement. So upgraded machine outflow is 10 lakh. New machine outflow is 20 lakh 20. Any doubts on this? Any doubts on this? Working note to in between flow. Working note to in between flow. In between flows. Particulars. Old machine, upgraded machine, new machine, incremental for option 1, incremental for option 2, incremental for option 1 and incremental for option 2. Particulars in that write 5 years. I'll explain this calculation. Many a times you may have to do old minus new, all that calculation will be needed. If I continue with the old machine, what is the PAT they've given? Expected PAT equal to CF80 because there is no depreciation on the old machine. There's no depreciation on the old machine because it's already fully depreciated. It's already fully depreciated. Book value is 0. Book value is 0. So PAT and cash flow is same. 5 lakh, 5 lakh 40, 5 lakh 80, 6 lakh 20, 6 lakh 60. If you upgrade PAT plus depreciation, if you upgrade PAT plus depreciation, what is the depreciation of the upgraded machine? 2 lakh, 10 lakhs on upgradation, 10 lakhs on upgradation. So 7 lakh 50, 7 lakh 90, 2 lakh is the depreciation, 8 lakh 10, 8 lakh 50 and 9 lakh. And our principle is always incremental. See, you cannot just say that because of the upgraded machine I'm earning this. No, because of the upgraded machine you earn the difference. Because of the upgraded machine you're earning the difference. So as such, whether you do replacement, or you don't do replacement, it's always new minus old only. It's always new minus old. Why in replacement I specifically talk is because I may analyze old machine separately, I may analyze new machine. In this question I'm analyzing old separately, upgraded separately. These two are same machine only. These two are same machine only. Old is also same machine, upgraded is also same machine, and I'm finding the difference. If you install the new machine, what is the depreciation per annum? 4 lakh or 4 lakh 10? Installation cost is to be considered for calculating depreciation. Installation cost is to be considered. So 4 lakh 10, add 6 lakh plus 4 lakh 10. 10 lakh 10, 10 lakh 50, 11 lakh, 11 lakh 50, 12 lakh 10. Difference. New minus the old. New minus the old. What happened? The old machine minus the old machine and new minus the upgraded old machine. New minus old, original. Here we're not taking upgraded old. Then I have to take for cash flow also, no? For example, we said 20 lakh 20. Then I have to do 20 lakh 20 minus this 10 lakh also. That option also can be done. Consider it makes complicated. Calculation will make it a little complicated. Which 2 lakh 20? What is 20 lakh 20? That is your block of assets method. Block of assets method will do all those adjustment. See, in my books of accounts, my sorry, not even block of assets. In my books of accounts, what is the extra fixed assets you are purchasing? 20 lakh plus another 50,000. Installation charge is also part of fixed asset. Installation charge is also part of fixed asset. So 20 lakh 50 is my fixed asset increase. 20 lakh 20 is my real cash outflow. Cash outflow has nothing to do with depreciation calculation. In your books of accounts, 20 lakh 50, what could have happened is, if the old machine also had some book value, then some incremental analysis could have been done. I'm doing new separately now, old separately now. Let's not club them together. It would have been auto considered here, and when you find the difference, your cash flow would have been lesser. So here you would have added 1 lakh, 1 lakh, 1 lakh, 1 lakh. What is the impact of this adding 1 lakh here? Your outflow, the difference would have been lesser. The difference would have been lesser. That's why I always prefer to do old separately, new separately, at least for step 2. Step 1, you want to club them together, please club it. I have no problem. Step 3 also, I want to do it separately. Step 2, my preference is always old separately, new separately, and then find the incremental. This is my preference. Your choice, how you have control on numbers. Ultimately, I'm going to do new minus old. Ultimately, that has to be done. What is the sale value of the upgraded machine after 5 years? Where is the 50,000? Zero. Even your new machine is zero, and we have already fully depreciated. We have already fully depreciated. So once you get the cash flow, you end up calculating the NPV. So in my upgradation option, 10 lakh was my initial outflow, and these were your 250, 250, 230, 230, and 240. In case of the second one, 20 lakh 20 was my initial outflow, and these were your numbers: 510, 510, 520, 530, and 550. Net net both are negative. Net net both are negative, which means I am not doing any replacement, and I'm also not doing upgradation. No replacement, no upgradation. Continue with whatever is happening. Continue with whatever is happening. Able to understand this? This is type 1 question. These are type 1 question. I have some good type 1 questions. These are CA Inter question. I don't want to discuss because this is exactly copied from CA Inter. I have done this in CA Inter in detailed discussion. You want, you please do it for your more understanding. New separately, old separately. Excellent questions. These are excellent questions, but are CA Inter. In this, I'll discuss this 18th CA Inter question. It's a very good problem. Please go through this. type 1 question preference will always be to do separately. I'll be discussing this question, no solving at all. Solving will take away at least 30 minutes if I have to do proper solving of this question. And it is a CA Inter. I'm doing this in my CA Inter material. Even in the current batch, these questions are getting done there. Okay, my first requirement, I want you to calculate NSV of old machine and tell me sale value, book value, capital gain, capital loss, tax paid, tax saved, and NSV. First requirement from your side, please do that calculation. Excellent question on replacement being done at CA Inter. So I don't want to spend too much time here. What is the sale value of the old machine? I have two choices, to give it to the supplier or sell it in the market. I'll obviously give it to the supplier. And supplier will also take, because my replacement means I'm buying the new machine and giving him the old machine. So sale value is 2,50,000. Book value? What is the use of accounting book value? We are calculating for the purpose of capital gain or capital loss. Income tax guys are going to say, what is the book value? 0. Income tax guys are going to say it is 0. Your accounting book value is of no use. So capital gain is 1 lakh, 2,50,000. Tax paid is 1 lakh. NSV is 1,50,000. Any doubts on this? NSV is 1,50,000. Now I come to step 2. Doing single step, impossible. That is, new separately, old separately will only work if you try to do incremental. You will 100% make mistakes. Now I'll explain item by item. Revenues of the new machine is how much? Tell me. Revenues of the new machine. Guys, I'm asking simple question. Revenues of the new machine. Don't tell me incremental and all. Revenues of the new machine. 1 lakh into 200. Why are you getting into 20,000 and all? 1 lakh into 200. Revenues of the old machine is 80,000 into 200. Some students tried doing the incremental. It will lead to mistakes only. Material of the new machine. 63.75 into 1 lakh. Old machine is 80,000 into 75. Doing directly 11.25 into 20,000 and all will not work. That is why incremental is not going to work. Wages and salaries. New machine. 37.5 into 1 lakh. Old machine 51.25 into 80,000. Supervision 25 into 1 lakh, 20 into 80,000. Repairs and maintenance 7.5 into 1 lakh, 11.25 into 80,000. Power and fuel. Depreciation. Okay, old machine, no depreciation. New machine. Guys, this is accounting depreciation. Why are you even telling me this? Income tax guys are not going to agree to this. Income tax guys are very clearly saying, give me straight line basis. What is the capex of the new machine? What is the salvage value of the new machine? 60 lakh minus 2 lakh 50 divided by 5 years is what income tax guys are interested in knowing. That is what they know. They don't know this 5 into 1 lakh or 0.2 into this. Corporate overage. Ignored. Corporate overage is ignored. So some students made mistakes on this accounting depreciation, book value depreciation, accounting book value, income tax book value. All these are of my no use. And in this question, there is also a terminal flow. There is an NSV on day 0, and there is also another NSV after 5 years. There's also another. This is for the old machine. That is why when you analyze old machine, Imagine that you have continued for 5 years and sold it for 35,000. Sold it for 35,000. Book value anyway was zero only. Capital gain is there. The question has data on that 35,000. So imagine that you have continued with the old machine. Again repeating. Imagine that you have continued with the old machine then doing this calculation. Any doubts on this? Can we proceed? Balance knowledge formality. 19 again CA inter. I don't want to discuss. Your wish. I would prefer you to do 2-3 CA inter questions. Why 2-3 CA inter question? That will give you the comfort. That will give you the comfort. Otherwise, you will struggle. Otherwise, you will end up struggling. So 2-3 CA inter question. Please start doing it. Please start doing those 2-3 CA inter question. Again, I'm repeating. My role is not that much there, but because you are not done the basics of the capital budgeting, because I've just discussed them. And if I do those cash flow related questions, they are very complex in nature. Though it is part of CA Inter, the question has lots and lots of adjustment. Again, repeating type 1 question, new separately, old separately, and then do incremental. Clubbing them together can save you some time in few questions. Which question you may not understand. I know which question will save time, which question it will increase your time. So you have no idea. Do new separately, old separately, and in the end say incremental. In the end say incremental. When you analyze new machine, please don't look at the old machine data. Don't say old machine depreciation so much, new machine depreciation so much, I find incremental. No, separately, it is like two separate questions. So when I told you to solve this question, this is one question for you and this is another question for you. Don't try to club them together. Would I club them together? Yes, in this question I've clubbed them together because I know it saves me time. I know it saves me time, but you may not know whether it is going to save you time or not save you time. So you don't try to club them together. You don't try to club them together. You do separate analysis for new, separate analysis. Will it take extra time? Yes, in this question it will take you extra time, but you don't know when to do, when not to do, and it will take you a lot of time. You will not understand when to do, when not to do. So let's not get into all this. New separately, old separately. Even the first question I did new separately, old separately. If I club them and do it together, I'll tell you it would have taken me half of the time I took in solving that question. It would have taken me half of the time it took me in solving this question. But again, the challenge is only one thing. You don't know. You don't know when to do it. Clear? Any doubts? Category 1 is over for me. Category 1 is over, which is analyzing new separately, old separately. Category 2. Okay, it's not a category 1 question. It is not even a replacement question, but go through category 20. Sorry, question 20. This is a EAB EAC question. This is a EAB EAC question. Go through this. Question 20 is not a replacement problem. I go back to EAB EAC. Okay. I did one question on EAC, one more question now. Okay. They're asking, will it be advantageous to buy plant A or plant B? I'll quickly discuss the full requirement of the question. Maybe you have not gone through it fully also. Life is 20 years, life is 15 years. So whether plant A or plant B is better, I cannot answer just by doing the calculation. I need to do EAB or EAC. Then there's another problem in this question. The another problem is both run for 2500 hours, but this produces more. Sorry, this produces less, other one produces more units, other one is producing more units. So they are saying substantiate your answer with the help of unit cost. What is unit cost? Is cost per unit. Unit cost is cost per unit. How will you do? You will first do EAB or EAC, which is per year. EAB or EAC is per year divided by production per year, divided by production per year. That will give me the cost per unit. Cost per unit. It is not stopping at EAB or EAC. It needs to go another step. It needs to go another step, which is called unit cost. Is there a tax rate given in the question? If tax rate is not given, it makes it more simpler for me. How does it make it more simpler? Without tax rate, I'll just put year, cash flow, PVF, DCF directly. Year 0, whatever is the outflow. 1 to 15 years, 1 to 20 years, whatever is the outflow. And at the end of 15th or 20th year, you may have some salvage value. You may have some salvage value. No depreciation, nothing needs to be done. What is, any idea what is capital recovery factor? Nothing to do with the, without this also I can solve the question, but any idea what is capital recovery factor? Okay, this is inverse of annuity factor. I need annuity factor to solve the question. They've indirectly given the annuity factor in the question. If you inverse the annuity factor, if you inverse the capital recovery factor, 1 divided by 0.1175 is what? That is the 20-year annuity factor. That's the 20-year annuity factor. 1 divided by 0.1315 is what? That is the 15-year annuity factor. That's the 15-year annuity factor. Let's do working note 1, computation of EAC. I'll do for only one plant, okay? Directly year cash flow PVF DCF. Year cash flow PVF DCF. Year 0. How many years is the life of first plant? 1 to 20 at the end of 20. Year 0, 1 to 20 and 20. We'll do only one plant. Second plant, the same calculation, we'll have to repeat. What is the outflow of year 0? Negative 24. Negative 24. Every year, can you tell me the outflow all put together? No depreciation, no tax, nothing needs to be brought in. All put together, what's the outflow? Nine lakh. In this, if they want, they can add a surprise element called a apportion fixed cost or allocated fixed cost. Normally, fixed costs are irrelevant. Nothing is mentioned. I'm considering, okay. 9 lakh 60. At the end of 20th year, what is the salvage value? Minus 960. Salvage value is my inflow plus 4 lakh. Salvage value is my inflow plus 4 lakh. Tell me 1 to 20 years annuity factor 4 decimal. They have used 4 decimals in the solution. 1 divided by 0.1175. If you did not understand capital recovery factor, you would do this calculation separately. You will have to do this calculation separately. I've just taken the inverse. 20th year normal factor is what? Point. This will give me PV of outflow. PV of outflow. It doesn't end here. PV of outflow. Any doubts on PV of outflow? After the PV of outflow, we need to divide by what? No, units is later. Annuity factor, EAC first. EAC is 105,10736 divided by 8.5106. At this stage, I'll change the sign, okay? 12,35,000. In exam situation, many students left it at this stage and said, I'll decide based on EAC. No, you cannot decide based on EAC because there is another thing, because A could be producing less, B could be producing more. Do the calculation and tell me units produced per year. Units produced per year. Please do proper calculation. It says 200 units per minute. 200 units per minute into 60 minutes per hour into 2500 hours. 200 units per minute into 60 into 2000, I'm getting the number as 3 crore. And cost per unit. Our decision will be based on cost per unit. We'll have to work with more decimals here. Maybe 6 decimal. Around 4 paise is the cost. This is not a question on replacement. No category 1, category 2, category 3. It is a question on EAB, EAC. This was a EAB, EAC question. Any doubts on this? 0.041167. Then you're ignoring time value of money. Because if you divide by 20, because in the denominator you're doing into 20. Let's see. So this is discounted. So then if I go by your logic, then I should take these numbers, no? We are taking these numbers, no? I should take these numbers for calculating cost per unit then. So it was discounted, divide by the annuity factor so that you bring the normalized cost and then divide by the number of units. Any doubts on this? Same thing will get repeated for the other one. So from a PV of outflow, this is higher. From a PV of outflow, this is higher. Net from a cost per unit point of view. From a cost per unit point of view. Now ICA has presented this in a slightly different manner. That's your wish if you want to present this way. I'll just explain what ICA has done. Net, the answer is same only. Answer is same only. Our annual cost is 9 lakh 60. They are saying capex every year cost. Every year cost is nothing but 24 lakh divided by the salvage value into the capital recovery factor. Into the capital recovery factor. Answer is same. I don't want to discuss it to be a different approach. What is the EAC you got? 12 lakh 35,016. So if you understand this approach, okay. You don't understand this approach, technically it is fine. The answer is going to remain same. Now I'll be moving to the type 2 and type 3 question. Go through question 22. Okay. In this example, I'm a taxi operator. Each taxi will cost me 4 lakh, life of 3 years, and they've given certain data. They want to know what is the optimal replacement period. That is, you should replace, that is, you're yet to buy also. You're yet to buy. So this is not technically a replacement decision. This is technically finding out the optimum life, determining the optimal life. Assume a life of 4 years. Compare the NPV or PV of outflow for 4 alternative. Use for 1 year, use for 2 year, use for 3 year, use for 4 year. So here I'll buy today. Use it for 1 year. What is the EAB or EAC will decide. Use it for 2 years. Use it for 3 years. Working note 1. Buy taxi and use for 1 year. Buy taxi and use for 1 year. Buy taxi and use for 1 year. Use for 1 year. PVF at what rate given in the question? Okay, 10%. Year 0, what is the outflow to buy the taxi? First year, use and sell it. Use and sell it. Only 1 year you will use and sell it. What is the cost of using in the 1 year? 1 lakh, and you will sell it for, so net inflow of 1 lakh. Net inflow of 1 lakh. Use and sell it after 1 year. Use and sell it after 1 year. Do the calculation. PV of outflow and EAC. Why EAC? Because there will be different options. There will be different option. This is, I'm using only for 1 year. I'm using this only for 1 year. If you use only for 1 year, you're spending 3,09,100, whose equated annual cost is divided by annuity factor 10%, 1 year. Annuity factor 10%, 1 year, which is 0.909. This is my first choice. If you buy the car and sell it in 1 year, you have indirectly spent 3,40,000 per year. You indirectly spent 3,40,000. Then the second option is buy taxi and use for 2 years. Use for 2 years. Buy taxi and use for 2 years. Year 0 negative 4 lakh. Year 1 is how much? Negative 1 lakh 80. Year 2 negative or positive? Positive 20,000. Divide by 2 year annuity factor. Divide by 2 year annuity factor. Cost is inclusive of? No, I'm not assuming anything like that. If it includes depreciation, then I have to remove it. These are cash flow. Tax rate is not there. Depreciation anyway doesn't impact my cash flow. No? I'm indirectly assuming depreciation is not there in the operating cost. If you assume operating cost includes depreciation, you have to remove that. No, that's a non-cash item. Depreciation is a non-cash item. No. What is the 2 year annuity factor? No, that's a normal annuity factor. 1.73. Okay, 735. So 3,15,000 is the EAC. 2 year annuity factor, I divide. Next option is use it for 3 years. Use the taxi for 3 years. This will give me what is the optimum life of the taxi. What is the optimum life of the taxi? Third option is use it for 3 years. Again, you will buy, spend 4 lakh first. Any doubts on the second option first? Any doubts on the second option? A fairly simple category of question. ICI material has a lot of things in this. Year 0 negative 4 lakh. Year 1 how much? 1 lakh. Year 2, year 3 negative 0.909826 and 3 year annuity factor 48. Best is to replace in second year. Optimum life is 2 years. EAC lowest. So though the car can be used for 3 years, doesn't make any sense to use it beyond 2 years. It doesn't make any sense to use it beyond 2 years, because at the end of 2 years it starts incurring lot of expenses. So we are saying I'll buy a car, use only for 2 years. This is called optimum life identification. And practically many asset classes, we may have to sell it before its life. Life is there, but no point in using this car beyond. No point in using the car beyond 2 years. Any doubts on the calculation? Based on EAC. EAC 3 lakh 40, 3 lakh 15, 3 lakh 17. So lowest is 2 years. Lowest equated annual cost is 2 years. similar question. I'll wait for 5 minutes. You quickly start doing it. But this will not be on EAC. This will be on EAB. But you start doing it. You start doing it. There's a rework that I'll explain. First, you do the optimum replacement cycle. Do evaluation of 1 year and 2 year. Please do year cash flow PVF DCF. I want you to do it. Problem doesn't have anything on this one. Sorry. Tax rate makes it simpler. Do 1 year life, 2 year life. 1 year life and 2 year life. The only difference is it will be NPV, I think. So we'll call it as EAB. We'll call it as EAB rather than calling it as EAC. Approach remains same. Initial negative 2 lakhs. If you use it for 1 year, 2 lakh 30 you will get. If you use it for 1 year, you will get 2 lakh 30. 1 lakh of net revenue and 1 lakh 30 of salvage value. 9978. Instead of using the word PV of outflow, I'll use the word NPV and EAB. What is the annuity factor? And it goes on like this. It goes on like this. I'm not discussing beyond it. But the point is here we are working with EAB approach. Higher EAB is better. There's one another last part called abandon. That alone I'll explain. Any doubts till this? Any doubts on this? Can we proceed? The taxi operator will keep changing the taxi every 2 years. That's what we are advising him. We are saying because he is a guy who is going to continuously need taxi. He will continuously need taxi. We told him that every 2 years go ahead and keep buying a new taxi. Any doubts on this? That and all. We are working with certain assumptions. That's all. Changes obviously happen in a practical world. As of now, the calculation is this: you change the numbers, answer change. Okay. Rework the problem in case the company wants to decide on abandonment. Nothing much changes. Listen, abandonment is a one-time exercise. Replacement is a continuous exercise. That is, a taxi operator will buy a taxi. At the end of 2 years, buy another taxi. At the end of 2 years, buy another taxi. If in this case you buy the machine today and sell off and don't buy it again, don't buy it again, then EAB approach is wrong. EAB basically says you have to keep repeating it multiple times. EAB works with the principle that this exercise will keep getting repeated multiple times. If you are going to say no, I'm not going to repeat it multiple times, then go by absolute amount of NPV. Go by absolute amount of NPV or absolute amount of PV of outflow. So in this case, if abandonment is what you are doing, then I'll directly do it till 3 years. I'll directly do it till 3 years. I don't want to cut it in between. I don't want to cut it in between. In case of taxi operator example, we'll have to go with PV of outflow. In that case, it will be that first year itself, close it. That's all. You don't want the taxi, then sell it off at the end of first year. Sell it off at the end of first year. Abandonment is non-repetitive exercise. Replacement is a continuously repetitive exercise. For repetitive exercise, EAB or EAC works. For non-repetitive exercise, normal PV of outflow or normal NPV is going to work. Now I come to the next category of the question, which is when should I replace the machine? When should I replace the machine? We have already decided replacement has to happen. I don't know when should I replace. Go through 24. This is the third category of the question. Go through it, and I want you to calculate one thing and then I take you forward. You buy the new machine, use it for 8 years. 8 years, what is the EAC? I want to know. Calculate that and keep. EAC of the new machine for 8 years. Thereafter, I'll take you through. EAC of the new machine by use for 8 years. I want you to do the calculation. So the printed solution has the number. I want you to do the calculation. After that, I'll take you through. No difference. New machine, separate analysis. Separate new machine analysis. Tell me 8 years. What is the equated annual cost? Please write year, cash flow, PVF, DCF, write and then do the calculation. Just get me the EAC of new machine. Year 0, 90,000 outflow. 1 to 8, 10,000 outflow. At the end of year 8, minus 20,000. See, all these questions, they can make it complicated by bringing income tax if they want. So, this is the number I get. Beyond this, I'll take you through. EAC is 28,600. Beyond this, I'll take you through. Get me this answer. There's a type 3 question, how type 3 and all I'll discuss. I just want you to do this calculation. Wait. Okay, let's start discussing it now. A company is contemplating whether to replace an existing machine or to spend money on overhauling it, and overhauling it currently pays no taxes. All that is done. The existing machine require increasing amounts of maintenance each year, and its salvage value falls each year as follows. So the value keeps changing. The existing machine can be used for another 4 years. Okay, so I technically have 5 choices. Should I replace today? Should I wait for a year and replace? Should I wait for 2 years and replace? Should I wait for 3 years and replace? Or should I wait for 4 years and replace? So you can replace 0, 1, 2, 3, and 4. If you replace, new machine will be used for another 8 years, which means this will be 8-year cash flow. This will be a 9-year cash flow. This will be a 10-year cash flow. This will be a 11-year cash flow. This will be a 12-year cash flow. You write the old machine for 1 year, new machine for 8 years. Old machine for 2 years, new machine for 8 years. Old machine for 3 years, new machine for 8 years. Old machine for 4 years. This makes it more and more complicated. A lot of calculation needs to be done. So there's a short way to do this question. If it was 1 or 2 year change, no, I would have done that approach only. That is, write old machine, then write new machine. Write old machine, then write new machine. What approach we are going to do is, in each of the 5 options, I will restrict my calculation till only 4 years. I'll restrict my calculation only for 4 years. How are we going to do the calculation? If you replace immediately, you will use new machine for 4 years, where the every year cost is 28,600. Where every year cost is 28,600. If you replace in year 1, you will incur the old machine cost, whatever it is. New machine cost is 28,600 for year 2, year 3, and year 4. 28,600 for year 2, year 3, and year 4. Beyond 4 years, I'm not doing my analysis. Beyond 4 years, I'm not doing my analysis. I want to restrict my calculation till 4 years. Why only till 4 years? That ensures the consistency is there. Can I do old 1 year and then write new? Yes, I can do it. In fact, in past batches, I used to do that. It used to take a lot of time, and ICA was not following that approach. ICA was not following, so I thought, okay, let me shift to the ICA approach as well. This is again a CA inter question. Was there in CA inter. I used to do it this way only, but because ICA is not doing it, the conclusion was remaining same. The conclusion is, when should you replace was remaining the same, but my numbers were totally different. ICA numbers were totally different, so I didn't want to deviate that way. So now what we are going to do is, replace can happen in 5 options. Now write alternatives. Alternative 1, replace today. Replace today, year, cash flow, PVF. In fact, okay, let's write it like this. You need not do the discounting part, okay? Year, cash flow, 5 columns. Replace today, replace 1 year, replace 2 year, replace 3 year, replace 4 year. You need not do the discounting part of it. Discounting, I'll show you the answer. Cash flow is what we'll focus. Year 0, 1, 2, 3, 4. Year 0, 1, 2, 3, 4. If you replace today, you will sell the old machine for how much? No, there is some value, no? 40,000. Use the new machine, negative 28,600. Every year, negative 28,600. Every year, negative 28,600. Sell the old machine for 40,000 and use the new machine, negative 28,600, only for 4 years. Beyond 4, I'm not doing my analysis. Can I do beyond 4? Yes, you can do it. Doesn't really matter, but I'm restricting my calculation only till first 4 years. That's the answer I told you to get, EAC. Any doubts on this? Then what you decided? No, I'll not replace now. So nothing happens here. No cash flow. No cash flow. First year, You use the old machine and sell it. What is the outflow or inflow all put together? You use and then sell it. Inflow 15,000. Inflow 15,000. How inflow 50,000? 10,000 and 25,000. 10,000 and 25,000. Then new machine 28,600. 28,600. 28,600. New machine 28,600. 28,600 and 28,600. Then what you do is, no, I don't want to replace now. I want to wait for one more year. First year, how much is your outflow? No, first year, 10,000 minus 10,000 minus 10,000. Second year, outflow, inflow. Then comes new machine 28,600, 28,600. Comes new machine 28,600, 28,600. Option 3. First year, how much outflow? Second year, third year, again outflow 20,000. New machine for 1 year 28,600. New machine for 1 year 28,600. Last option, first year outflow, second year, third year, fourth year. New machine is not coming into scene. If you want the new machine, you can bring in year 5, where 28,600 you will write for all. Year 6, 28,600 for all. Year 7, 28,600. So that's why we are not doing analysis beyond year 4. We are not doing analysis beyond year 4. And because it is going to be continuously replaced, for example, when you replace today, the new machine will get over in 8 year. 9th year, again the machine would have come, again 28,600. Again 28,600. So ICI said, let's restrict our calculation for 4 years. I'll again explain. Old machine, whatever you are incurring, incur it. New machine 28,600. Now what does the answer come? This is the first option which you would have written, where the answer is negative 41,653. This is your first option. 40,000 year 0, 28,600 1, 2, 3, 4. Second option, 15,000 for year 1, 28,600 2, 3, 4. Next option, 10,000 5,000 28,600. 10,000 20,000 20,000 and 28,600. Last option, 10, 20, 30, 40. The lowest outflow comes in option 1. The lowest outflow comes in option 1. Machine should be replaced immediately. Machine should be replaced immediately. Can I do calculation for extra years? Yes, you can do it. It is one, time consuming. Second, ICI is not in fact, that was easier for me to explain in the batches and all. But take ICI is doing this. Let me do this itself. So what we are doing here is we are restricting our analysis to only 4 years. Any doubts on this? Go through the next one. Tell me which type of the problem is it? Type 1, type 2, type 3. 3 type of questions I have told in replacement. Read and let me know. Whether to replace or not, what is the optimum life, or when to replace? When to replace? What are the two choices I have? Replace now or replace later. We'll focus on writing year cash flow. Discounting, let's not do. If you replace now, write along with me, year cash flow. Replace now, year cash flow. Year and cash flow, no discounting part. Okay, replace now, year and cash flow. Year 0, what is the sale value of the old machine? Minus 80. New machine, sorry, plus 80, plus 80, plus 80. You will sell your old machine today, plus 80. New machine for how much? 1 lakh. So plus 80 minus 150 minus 70. Minus 70. New machine will be useful for how many years? Each of the year, how much it will give? Now you may ask why I am not doing EAB EAC approach. I don't want, because this is easier for me to do. There, because there were so many options, life was for so many years, we had to calculate the EAB or EAC for the new machine and then do calculation assuming restricting our calculation till 4 years. Restricting the calculation till 4 years. Here I do not have so many alternatives also. And in fact, the question is very clear. Company wants to know whether it should replace now or wait a year later. I am very clear this is the best machine. I am very clear this is the best machine. This is if you replace today. If you wait and replace year, cash flow, year 0, nothing will happen. Year 0, nothing will happen. Year 0, nothing will happen. Year 1, you use old machine. How much you get? 40,000 salvage value. In fact, the old machine has one more option, 2 years life, but they are not telling you to do that. They are saying today or a year later. Today or year later. And then 2, 3, 4, you will get 80,000. 2, 3, 4, you will get 80,000. Any doubts on this? Now, this is my answer after discounting. I feel first alternative was 3 years life, second alternative was 4 years life. Same question gets repeated. ICI has closed this on the basis of NPV. I feel we should do EAB and then give the answer. But in case it gets repeated, close with your ICI solution. Don't get to the logical one. Don't get to the logical one. Logical one is I should go ahead and compute EAB or EAC. Why am I computing EAB or EAC? Because the life is different. 3 years vis-a-vis 4 years. When can ICI solution be logical? If it is just a one time exercise and not going to be repeated. That is when you buy that new machine, after that you will not buy again and again. That is not going to happen. Then ICI solution is logical. Then I go with ICI solution. But if you are going to buy the new machine again and again, then the logical solution is going through EAB. Going through EAB. Focus is getting the year end cash flow. Focus is getting the year end cash flow. Which category is this question? Category 1 is whether to replace or not. Category 2, optimum life. Category 3, timing of replacement. Is the machine already available with you? Read and let me know. Is the machine already available with you? Where is it given? Okay, ठीक है. Okay, well, what is the data given on new machine, old machine here? Is there any data on new machine, old machine? There's only one machine. The objective here is to find what is the optimum life of the machine. What is the optimum life of the machine? That is, you buy for 60,000 today, because for category 3 you need to know what is the today's sale value, what is the new purchase price. This is a category 2 question. Buy, use for 1 year, buy, use for 2 year, buy, use for 3 year, buy, use for 4 year. Go by EAB EAC depending on the data. It's EAB or EAC. I don't know whether you get a negative answer or a positive answer. So buy, replace at the end of year 1, replace at the end of year 2, replace at the end of year 3, replace at the end of. This is a optimum life question. This is a optimum life question, and this is not the timing of replacement. Timing of replacement means they'll have to give old machine data and new machine data. Old machine, what is the salvage value? New machine, what is the purchase price? Like the last question, today 80,000, tomorrow 70,000. Old machine will give you 40,000. Next year it will give you 40,000. All that is not there. Next one, which category it is? Last problem, the first line is not given. Can I be a photo? Which line? Replace for not given. No, we normally do not one time. No one time analysis. See, point is, if I'm buying a car, I get a benefit for 1 year, 2 year, 3 year, 4 year. They're not comparable at PVF outflow. They have to be compared only at EAC. You have to compare only at EAC. Tell me 27 which category? It falls under the third category. It falls under the third category, which is deciding the optimum life, which is deciding the optimum. At home, try one of the third one, 26 or 27. I don't see any major learning. ICA steady mat questions are there. That's why I've kept it here. That's why I've kept it here. Otherwise, I would have removed it also. These are ICA study material questions. Any doubts on this? So to summarize my replacement discussion, I have three types of question. Type 1 question, which is according to me the most complex set of question, where you have to do new machine separately, old machine separately, and get the incremental. New machine, step 1 separately, step 2 separately, step 3 separately. Step 1 will have capital expenditure and working capital. Step 2 will have revenues less all costs, PBDT less depreciation, PBT less tax, PAT, all that will be there. And then comes the third category, which is net salvage value, where you have two items, salvage value and recapture of working capital, NSV and recapture of working capital. When it comes to old machine, initial outflow for old machine is NSV of old machine on day 0. Terminal outflow for old machine is NSV of old machine in year 5. NSV of old machine in year 5. 2 NSV you have to calculate. 2 NSV you have to calculate. 1 working capital blocked, again recapture of working capital. Again recapture of working capital. And terminal flow is the same calculation. New minus old you do incremental. Type 2 is you're deciding when should I replace. When should I replace? Two types of analysis. One, I restrict my calculation till only a specific number of years, and I say old machine balance new machine, old machine balance new machine, old machine balance new machine. Balance new machine is EAC of each year, EAC of each year. Old machine whatever the number, old machine is whatever the number. Third is deciding the optimum life, deciding the optimum life, where buy sell in 1 year, buy no year 0, no year 0 there, buy sell in 1 year, buy sell in. When to replace can have a year 0, when to replace can have a year 0. Any doubts on this? Okay, next comes the inflation in capital budgeting. I'll quickly discuss, not sure whether we do a problem now or after break, but let me discuss inflation. Now, whenever I am buying any machine, I use that for a period of 10 years or I use it for a period of 5 years. Revenues today can be 1 lakh. Every year revenue will keep going up. One, because I increase price. Second, because of inflation. Because of inflation. So my cash flows can be with inflation. Cash flows can be without inflation. If you have it with inflation, it is called nominal cash flow, normal cash flow, money cash flow. Normal in a practical world, whatever cash flow happens, because Bharadwaj Institute would have been increasing fees every year. That does not mean we are earning anything extra. That's because of the inflation. That's because of the inflation. So in your balance sheet or in your financial accounts, you write nominal cash flow. You write only nominal cash flow. If you remove the inflation, it's called real cash flow. It's called real cash flow. Similarly, if you consider the discount rate with inflation, it's called nominal discount rate or money discount rate, and without it is called real discount rate. Now, just an example, this will give you good understanding. Today's sales 1000 into 50, 50,000. Next year sales 1200 into 55, 66,000. 50 becoming 55 is inflation. 50 becoming 55 is inflation, which is 10%. Which is 10%. 1000 becoming 1200 is real increase. Is real increase, which is 20%. How much is the turnover increase? 50 becoming 66,000 is what increase? 32%. It is an increase of 32%. Loosely, when I discuss, I can say inflation plus real increase is equal to nominal increase. Inflation, this is a loose discussion saying inflation 10%, volume went up by 20%, turnover will go up by 30%. But in reality, it doesn't happen that way, because two percentages can never be added. Two percentages can never be added. In this example, inflation is 10%. Inflation is 10% and sales increases 20%, but put together is not 30. Put together is not 30. Put together is what? 32%. So we have a formula called 1 plus real increase 20%, 1 plus inflation increase is equal to 1 plus the normal increase. 1 plus 20% into 1 plus 10% is equal to 1 plus 32%. Is equal to 1 plus 32. You cannot do 20 plus 10. Why did 20 plus 10 become 32? Reason is simple. 10 is right, 20 is also right, but this 10 increase is also applicable on that 20. 10 increase is also applicable on that 20. 10 into 20 is another 2%. 10 into 20 is another 2%. That's how that 32% happens. That's how that 32% happens. So what you should always do is, whenever we do calculation, I will need one money cash flow or real cash flow. I'll need money discount rate or real discount rate. Concept says only one thing. If you are using money cash flow, use money discount rate. If you have real cash flow, use real discount rate. How do I convert? Using this formula. 1 plus money discount rate is equal to 1 plus real discount rate into 1 plus inflation. Loose formula is MDR, money discount rate, is equal to RDR plus inflation. That's a normal. When I discuss with you, I'll say MDR is equal to RDR plus inflation. Inflation plus the real rate is equal to money. Just add 1 on top of it. Just add 1 on top of it. Can you give me the answer to this? No, that is discussion. That's not the real formula. Give me the real answer. Real answer is 1 plus. Real answer is 1 plus. 1 plus MDR is equal to 1 plus IR plus 1 plus real discount rate. 14.4%. Again, I'm repeating. Loose discussion when I'm doing with you, I can say MDR is equal to this. For example, I had this experience in my interview when somebody asked me a related question of this. So if I'm asking someone in an interview, if you give me 10 and 4, I'll say 10 plus 4, 14. That is like an approximate answer. That's just like an approximate answer. Exact rate you want, 1 plus MDR is equal to 1 plus RDR into 1 plus inflation. How do I move? Then I can move my cash flow from normal cash flow to real cash flow to nominal cash flow. All that we'll see as we proceed. I will explain the calculation part of it with the problem. I'll take a break. We'll resume around 3 o'clock. Around 3 o'clock, we'll resume.